Director at ICF Bank since 2005. For the first time in the more than 30-year history of ICSA, the International Council of Securities Associations is meeting here in Frankfurt in Germany. What a great pleasure for us, what an honor that the global organization of associations and self-regulatory organizations representing the securities industry on a global scale is our guest in Frankfurt, the financial center of Germany. On behalf of the BWF, a member of ICSA since 2008, I'm very pleased to welcome all delegates, observers and companions, colleagues and friends representing securities firms and banks active in securities markets from all over the world. From Australia, from Brazil, from Denmark, from France, India, Italy, Japan, South Korea, Philippines, Poland, Sweden, Taiwan, Thailand, United States, Vietnam, and New Zealand. Thank you all for coming from so far away and to attend the 3 days event of ICSA in Frankfurt. We are very delighted that you have taken this opportunity and accepted our invitation. I'm very pleased to welcome you, Urban Fernert, Chairman of ICSA and CEO of the Swedish Securities Markets Association, and Peter Eisenhardt, Secretary General of ICSA from London. Thank you so much for coming here. And we are very proud and pleased that the federal politicians from Berlin and the European and national supervisory authorities have also shown their interest in our international event. In particular, we have not only a wonderful and motivating words of greeting from our Federal Minister of Finance, but he will also be speaking to us in person in a few minutes. A very warm welcome then to Christian Lindner, Federal Minister of Finance. We are very pleased to welcome him as honored keynote speaker. And we have two other high-profile keynote speakers at our conference today. Paulina Demek-Hack, Director for General Affairs, European Commission, DG FISMA, and Dr. Thorsten Pötsch, Chief Executive Director of Securities Supervision and Asset Management, BaFin. A very warm welcome to you too. The Deputy Major and Director of Economic Affairs of the City of Frankfurt am Main, Stefanie Wüst, will also attend us this afternoon. After the keynotes, we will present 2 highly interesting expert panels, the first on the topic Improving and Growing Capital Markets. And after lunch break, a second on the topic Shortening of the Settlement Cycle. The international exchange of information among experts is paramount for promoting the harmonization of capital market regulations in a manner that serves both the best interests of companies in the securities industry and the financial economy in general. I'd like to take this opportunity to make a short appeal to our policymakers. We are in Europe so much in love with financial market regulation. It has just become an obsession to push it with its complexity further and further on several levels, with different levels of detail and from various perspectives, enriched with countless cross-references. In this increasing dimension of regulation, this paralyzes competitiveness, entrepreneurial creativity and development, which is so necessary to generate economic growth, to keep pace with technological developments, to create prosperity and fulfill social tasks, and to increase its attractiveness so that we can achieve our goals of climate protection and of digitalization. And it is precisely the small and the medium-sized service providers that we represent in our association that may then reach a point, one time, where they no longer can earn enough money to be able to meet all the requirements. We need to move away from this dimension of regulation, which also grows in other areas, towards a minimalism that focuses on the essential points and issues. and turning on the ongoing terrible and unbearable war in Ukraine in its third year, just a few personal words from me. This spiral of violence must not become Europe's destiny, shall not become Europe's destiny. Openness to the different ways of conflict resolution must not only be allowed in democracy, it must be, for me, it must be required. Do we have forgotten the art of high diplomacy? We must live again in coexistence together in our global community, whether we like it or not. Let me therefore conclude with the words of Cicero, the Roman lawyer, politician, and philosopher, who has gone down in history as Rome's most famous orator. Peace, even an unjust peace, is better than the most just war, he said. Let's return now to our focus to this beautiful, enjoyable, international and outstanding conference event. I wish you and us all a very productive and enriching discussions and fruitful international connections. And I now hand over to Mr. Urban Fernert, the chairman of ICSA. The floor is yours, Urban. Thank you.
So, thank you very much, Annette, for this introduction. And also on my side, ladies and gentlemen, speakers, we're so happy to have you here. Also on my side, as the chair of ICSA, I would like to welcome you all to this 37th conference and meeting of ICSA. And I would like to say on my side a warm thank you to our generous hosts, BWF, and with a special praise for the organizing committee that you will see on the next slide that's coming up soon. Or do I click it here, like that? Thank you so much to you and your team here at BWF. And I recall when we were approaching Michael about arranging this meeting and conference, well, in a very German way, he first wanted to take it back home, he wanted to discuss it. And when he came back on behalf of BWF, we understood that he had thought that when wir das tun, werden wir es richtig machen. So what he told us was, of course, that if we are going to do this, we are going to do it right. And all I can say is that you have really delivered on that promise and on that position. So vielen Dank to all of you for all of this. And as mentioned, I mean, we have a great program ahead of us. I will not repeat all of the speakers that we have. But in addition to our keynotes, Minister Linner, Dr. Pötsch, and Ms. Day-McCack, we have a couple of panels with distinguished experts from around the world, and we will discuss how we can improve and grow capital markets and how we can shorter or how we go about shortening settlement cycles. I just want to say to those of you who may not be that familiar with ICSA, I would like to take you back for a very short while, because these are not pleasant memories, to the stock market correction of October 1987. And of course, the phrase stock market correction, it was really a fatal crash in financial markets. So in the aftermath of the so-called Black Monday, policymakers, regulators, and economists started looking back at the causes of this meltdown that had happened in financial markets. And what they found was that we had had a growth in international investor participation, we had had a growth in derivatives markets, program trading, and portfolio insurance. So at the dawn of the 1990s, known then as the Great Decade of Globalization, it was clear that there were so many interlinkages that they were multiplying. We had lots of cross-border trading and cooperation, and we also understood, both on the public side and on the private side, that communication was crucial. So it was against this background, at the initiative of the Japanese Securities Dealers Association, that ICSA was founded in 1988. And it was founded by securities industry associations representing the world's largest financial markets. And the purpose of ICSA, as it's set out in the mission, is to share information, to work towards global practices, best practices, and promote mutual understanding. And what we do in ICSA is that we focus on working with standard setters at a global level. Because it's, and when we do this, and as a chair of ICSA, and having had the pleasure of getting a renewed mandate for another year, I have, during the last 5 years as CEO of the Swedish Securities Markets Association, found that our meetings and discussions in ICSA to be highly rewarding, because capital markets today are global, but they are also regional and national. And in Europe today, we're talking a lot about top-down, bottom-up, etc., but it's all really everything at once. And for us, working in capital markets, it also means that we have to remain active at all levels. So, for example, in my daily work as CEO of the SSMA in Sweden, we have excellent dialogues and relationships with the Swedish Ministry of Finance, with the Swedish FSA, as well as at European level with the European institutions and supervisory authorities in Brussels and Paris. And I know that my fellow ICSA colleagues are in a similar position as they are active at regional and national level. However, at global level, ICSA is the organization for all of us, because here we can meet, we can exchange information, experiences, etc., between our respective associations and markets. And we can also meet policymakers and regulators at a global level. And we're doing this today, and we are really, again, as I said, pleased with the meetings we had yesterday, but also the conference today. But we will also be a group of ICSA members who will, meet again in Athens next week to attend the IOSCO meeting and meet again with global regulators there. So, to conclude, we are waiting now for the Minister Lindner, and we are really pleased with BWF that you have arranged to have him here, and also for us to get the opportunity to listen to and learn more about what's happening here in the German market, which is, of course, extremely important for all of us who are working in Europe, but also to learn and listen to experiences then from other parts of the world. And I think you will find that we have a fantastic lineup of speakers and panelists today. So very much thank you to BWF. Thank you to all of you who are here today. And I look forward to the discussions in today's panels and to hear from our keynote speakers. So thank you very much to all of you. And I understand that we are just waiting for the minister to arrive. And I will just do it like that. I will just tell you that we are 20 members in ICSA, of which a majority are here today. And again, it's been fantastic to see the skyline here of Frankfurt and to be here in the library. And if we have a few minutes, I may sneak out and see if I can find any Pippi Longstocking books, Pippi Longstrumpf books. And here, now I think we can leave the floor to Michael and the minister.
Good morning, everybody. For those who don't know me, my name is Michael Sternzenbach. I'm the Secretary General of BWF, the host of this year's ICSA conference in Frankfurt. And it's a very, very, very great honor for us, and even more a pleasure, that the German Federal Minister of Finance, Christian Lindner, who just arrived, has accepted our invitation to deliver a keynote this morning to our global audience here. We have representatives from capital markets, trade associations, and SROs from more than 20 jurisdictions, which is a very unique situation. And we are very interested to hear and excited what the Federal Minister of Finance of Germany will have to tell us. And I don't want to lose any time and invite, dear Minister, please, the floor is yours.
Ladies and gentlemen, good morning and a very warm welcome to Frankfurt. It's a pleasure for me to speak to you this morning, and I'm delighted to see such a large gathering of distinguished participants from all corners of the world. I would like to take the opportunity to greet two representatives of the ICSA, its chair, Urban Funneret, and the Secretary General, Peter Eisenhardt. And I would also like to salute the German Member Association of ICSA and this year's conference host, the BWF, represented by its chair, Annette Kliffmüller-Frank, and Michael Sterzenbach, the Secretary General. This is not to forget all the other high-ranking ICSA representatives from an amazing number of countries, and last not least, I wish to greet and thank the numerous interested experts who have traveled here to take part in this international event. Thank you very much for inviting me to the International Council of Securities Associations Conference 2024. I'm very pleased that this year's conference is taking place in Germany for the first time, here in Frankfurt, at the heart of Europe, where history mixes with the energy of Germany's leading financial center. I hope you had an opportunity to get to know this fascinating city over the last couple of days. Frankfurt is one of the most important financial hubs in Europe. It recently moved up 3 places to 14th place in the Global Financial Centers Index, which ranks the competitiveness of financial centers across the world. And within continental Europe, Frankfurt came second after Geneva. Frankfurt will continue to grow in importance. Just this February, for example, the EU chose it as the future home of AMLA, the new authority that will be dedicated to fighting money laundering and terrorist financing. This will benefit the entire financial ecosystem around Frankfurt. In other words, you will always find it worthwhile to come back to Frankfurt. Of course, as Germany's finance minister, it's my job to promote my own country, of course. And it's not every day I have the opportunity to speak to people from Asia, Australia, New Zealand, North America, South America, and Europe. The last time was about a month ago at the spring meeting of the International Monetary Fund in Washington, where we discussed macroeconomic conditions and future economic trends. And do you know what happened there? A presentation on the weak global growth perspectives presented by the IMF's managing director was illustrated by a photo of the city center of Berlin. So Germany as a symbol of the global need for structural reforms. For me, it was a proof of the sense of humor even the IMF has, and a call to action for Germany. Germany's economy has real substance, intellectual property. We have a qualified workforce, but We have saw a decline in competitiveness over the last decade, and so we have to work hard for an economic turnaround in Germany. As I have said, we have the substance, but now we have to bring our country back on track to see further growth and economic success. We all face major global economic changes that affect us: climate change, demographic change, the technological transformation. Think about artificial intelligence, energy security, and growing international political uncertainties, just to name a few. They cannot be solved by public funding alone, but also require considerable additional private financing. That is why I'm putting so much effort into promoting a strong capital market. Capital markets have a critical role to play in addressing these challenges, and you, as representatives of these markets, have the vision, knowledge, resources, and experience to pave the way forward. However, in my advocacy efforts, I often see what a struggle it is to build a genuine capital market culture in Germany. It starts with the language. Venture capital, in other words, the investment that young companies need urgently, is called Wagniskapital in German language, which means risk capital. A new venture has connotations of a foolish gamble rather than creation of value. Ladies and gentlemen, investing in securities is not what is risky. In Germany, the risk lies in failing to take the advantage of the opportunities offered by the capital market. That is a disadvantage for those who want to save and for those who urgently need investment capital. This attitude is an obstacle on the path towards more growth. If we keep thinking like that, Germany will remain a symbol of stagnation. If we want to unleash our country's economic power once again, we need the courage to pursue more freedom now. I firmly believe that when it comes to investing in our future, we should rely mainly on private initiatives rather than government interventions. This is in line with the social market economy. Entrepreneurial risk creates innovative strengths and ensures that funds are used efficiently. To mobilize capital, the first thing we need to do is improving financing conditions in our country. Innovation needs financing, otherwise ideas cannot be turned into products. With the Financing for the Future Act, we have already improved access to the capital markets in Germany and made it easier to mobilize private capital, especially for startups and SMEs. This will make Germany's financial sector more competitive internationally and provide an economic stimulus. Ladies and gentlemen, in the area of finance, we cannot rely only on national measures alone. The challenges we are facing are too large for that. So I'm in constant dialogue with colleagues at the European and international level, for example, with my French counterpart. We all agree that national initiatives are important, but we need an European approach to deepen the capital market. And so we build on a Franco-German roadmap for a capital markets union in Europe. In the coming decades, Europe's economic strength will depend on our ability to mobilize this private funding. We need to develop the EU's capital markets in a way that unleashes private capital. And by the way, we have to reorganize our pension systems, coming from systems which rely on actual contributions to more capital market-based pillars, for example, like the Swedish pension system. Over the last 10 years, capital markets in other advanced economies have grown more quickly than here in the EU. That's why we need to make capital markets financing more attractive for companies in the EU. This also means making listing on European stock exchanges more attractive. We need to make it easier for young scale-ups in particular to access capital markets. The EU Listing Act will provide the decisive impetus for reform throughout Europe and significantly improve the framework conditions. For me, however, this is only the first step. We will have to build on it and start other ambitious initiatives. Capital markets in the EU are still too fragmented. This is a real disadvantage for Germany as a business location, especially for small and medium-sized businesses. That is why deepening the Capital Markets Union has long been a key priority for me, and the Capital Markets Union plays a major role in financing the digital and green transitions. In mid-March, the Eurogroup, in its inclusive format, issued a statement on the future of Capital Markets Union. It was built on the already mentioned Franco-German roadmap. It underlined the member states' joint commitment to making progress in this area. This offers a good starting point for deepening the Capital Markets Union, and the main priorities have been identified. Now we must implement the concrete measures, especially when it comes to securitizations, which are at the top of our European agenda. We are a long way away from fulfilling our potential in the area of securitizations. An active EU market would open up additional financing channels for banks and thus make a substantial contribution to financing transformation. The task now is to capitalize the momentum of the declaration. The future European Commission needs to put the Capital Markets Union at the very top of its list of priorities. And we will have to make efforts in the Basel Fora to improve the framework conditions as well. For me, another major priority in this regard is reducing bureaucracy at the national and international level, and in the EU. We are working to prevent further bureaucratic burdens on the financial sector. As we all know, that is something Brussels has a knack for. This is also why I'm taking a very cautious approach in the current discussions about extending the powers of the European Securities and Market Authority. It is certainly true that we need to make sure regulated market participants, products, and markets are treated uniformly across the EU. To this end, we must first and foremost improve the convergence of structures and supervision. But extending ESMA's powers, it's not necessarily the answer. Our focus should be on avoiding and cutting red tape wherever possible. We need to make sure we do not create expensive duplicate structures, especially for smaller market participants. Ladies and gentlemen, here in Germany, I'm known as a strong advocate for the market economy. Under the liberal, in the sense of social market economy, order, the market needs clear rules for competition, but the state's role is that of the referee. It's not of being one of the players. Its actions should be limited to creating a regulatory framework that is as lean as possible. Specifically, this means less red tape, faster procedures, more trust. The state needs to side with newcomers and outsiders who need the help accessing markets and opportunities for innovative disruptions. But the state is not the best entrepreneur. It's not the government's job to tell companies how to run their businesses. In fact, any form of government intervention carries the risk of distorting market signals, which in turn can lead to missed opportunities. We need to do the opposite. We need to create scope and good framework conditions. When it comes to intervention, less is more. Ladies and gentlemen, at the beginning of my speech, I told you about the IMF presentation and the sense of humor I have witnessed in Washington. It's a moment I don't want to experience again. And this is my motivation. I will do everything I can to prevent a repeat of that situation, and to make Germany a role model again is our purpose. For more than 3 decades, you at the ICSA have played a huge role in promoting the healthy development of capital markets around the world by working towards the harmonization and mutual recognition of procedures and market regulation. Please keep doing what you are doing. Thank you very much for your attention. I hope you have a successful conference here in Frankfurt, and as I said earlier, Frankfurt looks forward to welcoming you again. Thank you very much.
Thank you very much, Minister Lindner. This was not only thought-provoking, this was also, I think, very encouraging. Thanks for focusing and for your emphasis on the importance of capital markets, and also for mentioning that regulatory activities are not an aim in themselves. Thank you very much, Minister Lindner. After the keynote of Minister Lindner, which I think was really interesting and which did focus on many different aspects, also mentioning the right balance between international harmonization and having an eye on the particularities of different capital markets, we come to our second keynote speech. And even though Minister Lindner also did focus on, as I just mentioned, that financial market regulation never should be an aim in itself, I think we are also at the same time advocating that financial markets need a certain degree of regulation in order to build trust, to build resilience, and to promote investment in these markets. And who else could better complement the keynote of Minister Lindner here in Germany than the Executive Director of BaFin, Dr. Thorsten Pötsch, who is responsible for the way financial markets regulation is conducted in Germany, while the rules most of the time are originated in Brussels today. We are happy to have afterwards another keynote from the European Commission. But for now, I'm very glad and happy to welcome Dr. Thorsten Pötsch with his keynote. Please.
Good morning to all of you from my side. Annette Kliffmann-Frank, thanks a lot for inviting me, and thanks for the honor and privilege of addressing you today. And thank you for using an old photo of myself, so I don't look that old. It's great to welcome such a group of distinguished capital markets experts here in Germany's Financial Center. So we've already seen some of you have come a very long way all around the globe to participate in this conference. So you probably don't deal with BaFin on a regular basis, and some of you don't want to, might not want to. Therefore, let me briefly introduce the BaFin to you. We are Germany's federal financial supervisory authority. Our mission is to ensure the proper functioning, stability, and integrity of Germany's financial system. BaFin's tasks include banking, insurance, and securities supervision, the prevention of money laundering and terrorist financing, and the resolution of banks. Our teams are based in Bonn and, of course, here in Frankfurt, not Berlin. We're a German authority, but a large part of our work concerns Europe, because a great share of the regulations and directives that shape our work originate in the European institutions. Therefore, we are deeply involved in the work of the European supervisory authorities. For example, I have the privilege of chairing the Sustainability Standing Committee of ESMA, the European Securities and Market Authority. At BaFin, we have set ourselves high goals regarding our participation in European institutions. We want to be an opinion leader when it comes to defining the rules for European financial markets and to shaping supervisory standards. Today, this is more important than ever. Because we need strong European capital markets to transform our economies towards climate neutrality and digital transformation. Therefore, we must invest enormously. Just take the EU's Green Deal and the Repower EU programs. They deal with the transition towards climate neutrality and sustainability and sustainable energy. The European Commission estimates that in order to meet the objectives of these two programs, we need additional annual investments of over 620 billion euros. 620 billion euros. Such a large need for investment requires private capital. This is why the further development of European capital markets towards a capital markets union is so important. The Capital Markets Union is not a new project. We have been working on this for almost a decade. The list of the outstanding regulatory projects is long. The Listing Act, the Retail Investment Strategy, EMIR 3.0, FIDA, which is not a dog, formerly known as European Finance. There is still much to be done. This will also be true for the new European Parliament and the next European Commission. Europe must be an attractive and a safe location for capital market players. So what will be important in the upcoming years? Firstly, and we've heard this just a few minutes ago, we must reduce complexity and lessen the burden of bureaucracy. This is important for several reasons. Companies need to comply with complex rules. Supervisors need to enforce them. This creates high costs for everyone involved. At the same time, complex rules raise the barriers to market entry. They limit competition. Complex rules also impede consistent supervision at the European level. Now, the term complex rules sounds rather abstract. Let me give you a specific example of what I mean. Take the MiCA regulation, the Markets in Crypto Assets regulation. This has put in place a binding regulatory framework for the regulation of crypto assets and service providers in Europe. MiCA will provide a high degree of legal certainty for suppliers and consumers. We highly welcome this. However, MiCA also has 52 Level 2 and Level 3 acts to clarify the regulations. 52 Level 2 and Level 3 acts. Does it really help to have so many rules? Do we actually need a set of rules laying down standard forms and templates for crypto asset white papers? Could it really not be simpler, more pragmatic? If Europe wants to harness the potential of capital markets, it must not stand in its own way. Regulation should not regulate every little detail. It must address the major problems. And it must set clear guardrails. This gives certainty to all the parties involved. This reduces bureaucracy, and it will also allow for quick action. So what needs to be done? We should leave the calibration and stringency of financial market regulation untouched. However, we need to systematically consolidate and streamline rules from level 1 to level 3. We should also do a better job of integrating the various laws relating to the digital aspect of the single market, especially looking at the interface between sector-specific rules and horizontal regulation. For example, in the areas of data protection and artificial intelligence. Ladies and gentlemen, less complex rules are also more effective rules. And that brings me to my second point, the regulation of sustainable finance. In recent years, there has been a significant increase in the amount and in the density of European sustainability regulation. Now we need to ask ourselves, are the new rules really having an anticipated effect? I don't believe they have. The highly complex rules that we have at present are not helping to direct more funds to sustainable products. Demand is stagnating. Now's the time to reduce the complexity of sustainability regulation. We should simplify and consolidate the existing rules. And we should integrate them into a single consistent ESG rulebook. The current review of the Sustainability Financial Disclosure Regulation presents a great opportunity to kick off simplification efforts. We should start by providing a clear definition of what a sustainable investment actually is. This is absolutely indispensable if we want to achieve transparency and in order to steer investments towards sustainability ends. It goes without saying that when it comes to clear and precise definitions, we need consistency around the various ESG regulations. Greenwashing is another point. We've been discussing this topic for many, many years. Last year, the European supervisory authorities published a preliminary report on this topic, which included a common understanding of greenwashing. By the way, the final report will be released very, very shortly. Another step the Commission should take in the context of SFDR review is to create an easy-to-understand European system for ESG product categories. A system that would provide clear guidance for investors with straightforward messages, such as this product invests in sustainable activities, this product invests in transformation projects, and even if its investments aren't fully sustainable, this product excludes investments in certain areas, such as environmentally damaging activities. Ladies and gentlemen, reducing complexity, providing clear definition, and consistent information, such things should make it more attractive for investors to invest in financing the transformation. Such steps are absolutely necessary in order to further drive and even accelerate investments in the transformation towards sustainability. With that, on to my third point. We need to push ahead regulatory projects that have the potential to strengthen Europe's position in the digital space. We are currently witnessing profound technological change in the entire financial industry. Innovation is thriving. New and existing players are redefining entire value chains. Such times of disruption presents great entrepreneurial opportunities. With regulations such as the AI Act or MiCA, Europe has created a strong legal basis for digital companies to thrive. Yes, companies must abide to these rules, of course. This comes at a cost. But these regulations, provided they are clear and simple, also provide legal certainty. And let's take the famous MiCA as an example again. Our North American and Asian counterparts keep telling us this is the benchmark when it comes to crypto regulation. Now it's important to conclude regulations that can further nurture Europe's capital markets in the fully digital world. Let me just give you two brief examples. The Financial Data Access Regulation, also known as FIDA, will oblige companies to provide their customer data to other financial institutions and financial information service providers. Always with the consumer's consent, of course. consent, of course, and always only to companies within the regulated financial industry. This secure and efficient access data and data access will open up new business opportunities for established companies and for new players on the market. We will very likely see new innovative business models as a result. Competition is likely to become more intense. Second example, the consolidated tape. The consolidated tape will provide consolidated data on prices and volume of traded securities in the EU. This will improve overall price transparency. Currently, we have many trading venues in the EU, and thus also strong competition. That's good. At the same time, however, liquidity in individual financial instruments is split between different trading venues. A consolidated data ticker will combine this liquidity virtual. The three planned data tickers will support the efficiency, transparency, and integrity of EU financial markets. These regulatory projects can significantly advance European capital markets in the digital environment we all live in now, because they set clear guardrails for an efficient exchange of data, and because they reduce transaction costs and enable new business models. And there's one aspect that's important. Regulations such as FIDA, or the European Single Access Point, which will consolidate financial and non-financial information that companies disclose publicly, will ensure that more reliable data is more readily available in the future. This will be crucial for new AI applications. Even though there's a lot of work to be done for the next Commission, and for all of us, I'm convinced the reliability of information and data will be a strong competitive advantage for Europe in the years to come. Fourthly, and finally, Europeans must pay heed to the fact that in a digital world, financial service providers can easily scale globally, and they can move quickly. We thus have a strong interest in having effective rules in place in all major financial centers around the world to ensure financial stability, but especially to provide companies with open capital markets at a level playing field. This will boost growth and competition. This is in the interest of both the financial industry and the consumers. Europe has an economic weight. The next Commission should leverage this weight and advocate for clear and fair rules across the globe. If we don't bear this in mind, Europe will fall behind the US and the Asian capital markets. For this reason, and speaking as a regulator, I insist, let's move ahead with a deep digital capital markets union. Ladies and gentlemen, Europe needs significant investments to finance its economic transformation. Effective capital markets are critical. Reducing bureaucracy, making sustainability regulation more effective, and further driving regulatory certainty for digital business models will be key. There's a lot of work waiting for regulators, decision makers, and of course companies, but I'm sure it will definitely be worth it. Thank you.
Thank you very much. You will not be surprised that the idea of reducing complexity in regulation is very much applauded by, I think, everybody in this room. Yeah. And we are certainly ready to help in this project. Thanks a lot. Yes, thank you, Dr. Pütsch. And it's my very great pleasure to welcome the third keynote for today, Mrs. Paulina Demiek-Hack, Director for General Affairs with the European Commission's DG FISMA, and I think it's very important and very delightful that we have a representation from the European Union, since the capital markets regulation process and legislation process in Europe is always, almost in every case, starts in Europe and then comes down to the national level, even by implementing a directive or in form of a regulation, which is directly applicable law. And we are very keen now to learn and to listen what the agenda and the work program from the Commission's point for the future of European markets look like. Paulina, the floor is yours. Thank you very much.
Good morning, everyone, and I will just pull a little bit of water. Thank you so much, Michael, for the nice introductory words, and again, a very good morning to everyone. Great pleasure, honor to be here in Frankfurt today, and I understand also that it's the first time that this important gathering takes place in Germany, so well done for that, and congratulations to the organizers. I'm always very happy to be back in this region. I spent some of the best years in my life in Heidelberg, which is a nice town about 1 hour south of Frankfurt. I understand that you had the opportunity during the last couple of days to visit some other beautiful places in the region. So if you come back, make sure that you also visit Heidelberg. It is worthwhile, and you will not regret it. Now, it's a little bit challenging to be the third keynote speaker. A lot has been said already very eloquently by the Minister, of course, and by Mr. Pötsch. I will try to hopefully not duplicate too much of what has been said already. There is beauty in repetition, but I would have sympathy if you at some point thought that, okay, we get the message now, we've heard it. So I will try, hopefully, to be a little bit complementary to what other speakers have said, but obviously, inevitably, you will also probably hear a couple of things that you have already heard this morning. Before jumping into capital markets and capital markets union, just a short point on where we are in the European cycle. Several speakers have referred to the fact that there will be a new commission coming in, a new regulatory, if you wish, institutional cycle starting here in Europe. And that is indeed the case. We have 5-year periods here, 5-year mandate periods, but before a new commission can take office, and that would be kind of my employer, my highest bosses, we have an important moment, which are the elections to the European Parliament. And many observers have said that 2024 is a bit of a super election year. Around, I think, half of the world's population, including, by the way, in some of the countries that you are very familiar with, are having the opportunity, or sometimes, well, not all elections are free and fair, but that's another debate. But anyway, we have the European elections now in a couple of weeks' time, and that's important. We have the, I think, personally, big privilege in Europe that in addition to our local, regional, and national elections, we also have the opportunity to vote for our members of the European Parliament. And this is important because the European Parliament, together with the member state, it has a lot to say in our regulatory and legislative processes, including, by the way, on all financial market-related issues. So important elections, and they will take place in a few weeks' time in June. Now, what I wanted to touch on briefly, and very much in line with the topic, the big topic of the day, is, of course, capital markets and our EU Capital Market Union project. I also want to say a few words about financial literacy, financial education, and financial competencies, something I think has not really been mentioned yet today, but which I think is important. And on purpose, I use the 3 words, education, competence, literacy. Sometimes we mix them up a little bit. I think all of them are important, and it's of course all to do with how we can make sure that consumers, that retail investors are well informed about financial market issues, but more importantly, can take good and considerate decisions for their own personal finances. But now, briefly on Capital Markets Union, and Mr. Lindner and Dr. Perch have referred to it, I think, in a very eloquent and rather comprehensive way already. This is important. I think the good news is that we have made some progress. I think the first piece of good news here is that we know quite well what the issue is. Minister Lindner was referring to some of the challenges in a German context, but I think it's fair to say that some of these challenges are quite common throughout Europe. And what I have in mind here is, in particular, the possibility to access finance for small companies. We have a lot of innovative, good ideas in Europe. No reason why we would be less innovative than others. But what has proven to be a challenge is for these companies to scale up, to go public, but also to access venture capital. The minister was referring to that. And what we have seen also sometimes is that companies actually delist from Europe, choose to go somewhere else, or that they basically choose their first listing somewhere which is not in Europe. So a little bit regardless of what parameters you want to look at, you would kind of see that Europe probably is a little bit lagging behind other major jurisdictions. US is, of course, always the example being made, and I know that we have US colleagues in the room. I think we need to be a little bit careful with these comparisons because every country is different, every jurisdiction is different. The EU is 27, we are not one country, we don't have the US dollar, but anyway, it's clear that Europe probably should not be lagging behind as much as we do if we look at this objectively. So that's the first thing here, the analysis of the situation. We have a single market for capital, but in reality, we see that it's not probably working exactly as well as it should. The second point here, where I think is also a general and universal agreement, is that having deep and integrated capital markets is really important. And the reason that this is maybe even more essential now than it's been 10 or 20 years ago is, of course, linked to the various challenges we are facing. And I think every speaker has referred to them, the geopolitical context in which we find ourselves, the shifting geo-economic context, where Europe is, of course, relatively speaking, getting smaller in economic terms. We have massive transformations that we need to finance. Dr. Perch mentioned some very impressive numbers, and it's a digital transformation which is, of course, happening, but also, and very importantly, the net zero transformation. The EU has a Green Deal. We've done a lot on sustainable finance, but it is a lot of funds that basically need to be mobilized for this. Public finance can play a part here. The minister was referring to it, but it's very, very clear that we need our private capital, our capital markets, by the way, our banks, all actors in the financial system, to also play a very essential role in this financing. We also have in Europe the issue of the 27 together, our single market. We want to make sure that we have a so-called level playing field. We wouldn't want to see kind of distortion of competition between our member states, and that is why this common capital market union project is too important. So that's the second point. Now coming to the third point, and that is again something which I think is more in the category of good news rather than bad news, and that is that we have actually done quite a few things. We started off on the Capital Market Union project back in 2015. It's a long time or a short time, depending on perspective. And we have done quite a lot, and I think some of the measures that have been taken at the EU level have been mentioned by previous speakers. Now, we need to bear in mind here that some of these agreements, some of these regulatory legislative agreements are relatively recent. For example, the Listing Act, which will make it easier for smaller companies to list their shares on a public market. Consolidated tape has been referred to, which should bring efficiencies and transparencies to trading. We have the so-called ESAP, which is our European Single Access Point, which will be the idea of grouping together in one place the information that investors need about companies. But all these things are relatively recent, which means that they have been agreed by our legislators, European Parliament, which I referred to, and our member states, but they are not yet implemented, which means they have not yet been able to kind of show their effects on the ground. And hopefully, when some of these new measures are in application, are in force, we will hopefully also see some of the advantages. So these were, let's say, the 3 pieces of good news. We know what the issue is, we know why it is so essentially important, and we have done quite a lot. Now, the maybe not so good news is that it is still not enough. And I think this kind of sense of urgency has been echoed also by previous speakers, by the Minister, by Dr. Perch, by Dr. Frank, that we probably need to speed up. And the Minister was referring to the very instructive work by the finance ministers, the European finance ministers, that have, the Minister mentioned the statement. This work has also been taken up by our leaders, our EU heads of state and government, which have identified the work on capital markets, the work on capital markets union, as something which is absolutely essential to the EU's competitiveness. And minister and leaders discussed this back in April, and they will probably get back to that now in June. We also had a report written by former Prime Minister of Italy, Enrico Letta, which was looking at the EU single market, was looking at EU's competitiveness, and which also put quite a lot of focus on capital markets and the fact that more needs to be done in this area. And several of the speakers have referred to the fact that this means work for the next Commission. I can, of course, not prejudge what my incoming political masters would like to do, but it seems that a lot of the issues have been identified. Minister Linder mentioned sectorization. We have spoken about pension systems, how they are built up. Supervision is something that keeps coming back in this debate. And burden reduction, I've heard it loud and clear from every speaker, something that we see as well from the European Commission side. We are receiving a lot of feedback from stakeholders which says that the rules are quite complex, and this is something that we need to be looking at. Sustainable finance was mentioned as an issue, as an area which is new, which is extremely important, but where there is also objectively a lot of new requirements coming into place. So that's important, I think, to be looking at ensuring that we have rules that make sense, that we have rules that do not duplicate each other. Of course, at the same time, in the area of financial markets, I always feel obliged to make this point. We need to be very, very careful about deregulation. We saw, of course, the consequence of this leading up to the global financial crisis. So I think finding that balance is always really important. Sometimes when we discuss capital markets in Europe, you get a little bit of a sense that it can be perceived as a zero-sum game, in the sense that if one financial center gains something, another financial center has to lose. My personal conviction is that there is a way of making this beneficial for everyone, for all member states, be they smaller, be they bigger, be they wherever they are in Europe. We clearly have financial centers like the one we are standing in today. I think what's important here is that the access to finance has to be for companies and member states across. But of course, our financial centers will be focusing on different areas and will be, providing these services across the union. And I think it's really a matter of kind of everyone finding their place there. And I think there is a place for everyone in that ecosystem in Europe. Of course, some conversations here need to be national, some need to be European, and it's really a matter of bringing the various bits and pieces together in an efficient way. So that's a little bit the first leg when we think about capital markets, the access to finance for European companies, for our innovators, for our startups. And then the second piece is the retail participation in these markets. Now, in Europe, we are very good at savings, which means that there's a lot of money standing on bank accounts. What we, at the aggregate European level, have been a little bit less good at is to actually put this money to productive use for ourselves, for our retirement projects, for lifetime projects in general, but also, of course, this would be important from the context of financing these big transformations that have been referred to, be it the green net zero transition, be it the digital transition. There are things member states can do to incentivize consumers to invest on capital markets. You can, for example, look at tax incentives. I mean, the Swedish model has been mentioned. I'm looking at Urban here. I'm actually Swedish myself, although my name does not give it away. And clearly, government can, by policies, make it easier for retail consumers, for retail investors to put their money on the capital markets. But I think there's an important additional element here, and I mentioned that initially already in the beginning of my remarks, and that is the kind of financial literacy piece, the financial competence piece. And of course, if we want consumers to actually be confident to invest on the market, and by the way, not everyone has the financial space to do so. We need to bear that in mind as well. There are people in Europe, as in your countries, who don't even have the luxury to reflect on where they can invest because they don't have the financial means to do so. But for those who could do it, I think there is an important piece, which is financial competencies and financial literacy. And we did some interesting work on that in the European Commission last year. We conducted a so-called Eurobarometer. It's basically a survey that's being carried out across the 27 EU member states with a representative number of people per country. And it was a survey in several parts, one being really the financial competence part, the financial knowledge part, which questions like, if inflation is 2%, is your money worth more or less after 2 years? Compound interest rate, whether people knew what that was, whether it's a good idea to diversify your investments or not. So relatively basic questions, but you'd be surprised that a lot of people did not get it right. So that was one piece. And then the second piece was more on your own planning. You know, do you have emergency savings if you have a life event that changes your circumstances? Do you usually do a budget before you do a big purchase? So that kind of questions. And all in all, the result of this was that around 18% of Europeans had a high level of financial competencies, 64% a medium level of financial competencies, and 18% a very low or very low level of competence. And of course, this is the aggregate, the differences. There were differences between member states. Those member states that actually have a higher percentage of retail participation, again, the Swedish example, but also, for example, the Netherlands, there you also see that the level of financial literacy, the level of financial competence is higher. Now you can ask yourself, what's the chicken here, what's the egg? Are people better informed because they do this investment, or did they do the investment and then they got better informed? Now we can look into that, but it's kind of interesting to see this difference. Also what we saw, and I think that mirrors very much these kind of surveys also at an international level, you see, of course, also differences depending on level of education, depending on background, and also, unfortunately, I have to say, between men and women, so clearly a lot of work to be done there. Ladies and gentlemen, I think I will leave it at that. I think on the one hand, the whole capital market discussion, so essential for Europe at this venture. I do like to link to that also this issue around the retail empowerment, because that's what it is in the end, people feeling empowered to make the right decision, obviously getting the right advice and making the good choices for their own personal finances. We live in a complicated world. We also live in a world which is very global, which is very interconnected. So that's why I think we are all here from Europe very, very happy to have the opportunity to exchange, to learn from you, to listen to each other. And I'm looking forward to the further conversations today. And with that, thank you very much for your attention.
Very, very informative. Thank you.
Darf ich ganz kurz was fragen? Ja.
Yes, esteemed colleagues, dear friends, after these 3 impressive and encouraging keynotes, I got the feeling we have a lucky streak today. The German government promises us that it will stronger focus on capital markets and capital markets as a contribution to financing the German economy. And we've learned from the regulator that regulators are keen on reducing complexity. And now we've heard from the European Commission, from Paulina, that deepening and getting the capital markets union done, to say so, is on top of the agenda, and part of it is to encourage and to foster the involvement and the motivation of retail investors to participate in capital markets. This is something which, in particular, I think BWF members are very happy to hear, because even though our direct market counterparts are usually banks and other financial institutions, many of our companies, they serve markets which are particularly designed for the needs and of retail investors. But I think altogether, I think this was really, if 50% of this, what we've heard this morning, comes true, I think we can be very, very glad. And we now come to the second format of today, which is the expert panels. We will have 2 of them. The first of them will focus generally of how to improve and to grow capital markets. In other words, if I understand this correctly, we will be talking about, after all the positive signals we've heard from our keynote speakers this morning, how we as an industry participants and representatives, can do our homework to support this project. And I'm very pleased and happy that my dear friend and our chair of ICSA, Orban Funneret, will moderate this first panel. And Orban, please invite your panelists to the stage.
So, thank you very much. The selected few, may I ask them to come up here? Adam, Paulina, I will introduce you once you're up here. Peter, Motonobu, and Marco, please. Let me see now. So I'm very pleased to have this distinguished panel here. Sorry, I don't know. Yeah. So, thank you. Well, as Michael said, I mean, everything has been said and done already in the keynotes, in a way. I mean, we're on a lucky and good path upwards in our market. But of course, there is still more to be done. And that is why we're going to have this panel in the next hour or so. We will talk about how we can improve and grow capital markets. And to help me in this discussion and to take us forward and give us new insights, I have a fantastic panel here. I have from the right here, from your side, Peter Matheson, who is a Managing Director of International Policy and Advocacy in SIFMA, the Securities Industry and Financial Markets Association, based in Washington, D.C., but a distinguished background also in Her Majesty's Treasury and in the British Embassy in Washington. We have Marco Venturuzzi, who's the chairman of AMF Italia, but you're also a very distinguished professor at Bocconi University. We have Adam Farkas, who's the CEO of the Association for Financial Markets in Europe, AFME, but you also have a very distinguished background in both public and the private sector, including as Executive Director of the European Banking Authority. We have Paulina Day-McHugh. You have already made your mark here in the keynote, but you're Director for General Affairs at the European Commission's DG FISMA. And you also have a long and distinguished career in the European Commission. And we were also colleagues for a short while when you were, I think you were seconded or on loan to the Swedish permanent representation in Brussels during the Swedish presidency to the EU before the one we had a few months ago. Yes. And then, of course, we have Motonobu Matsuo, who's the COO for the Self-Regulation Board of the Japan Securities Dealers Association. But you also have a very distinguished background in the Japanese Ministry of Finance and the Financial Supervisory Authority. And so that is the panel, and I am then the CEO of the Swedish Securities Markets Association. So, I mean, with this panel, we will be able to get an overview and some insights from all across the world. And what we have heard today is, of course, as we are in Frankfurt, that Europe is, like most of the world, lagging behind the big capital market in the United States. And we have also heard how we need in Europe, we need to increase the retail participation in capital markets. But we also need to increase the interest of European companies and also companies elsewhere in the world to go public. And we know that there are several reasons why they may not want to do that, why they stay private or family held or whatever. Part of it is because of bureaucracy, but there are also other factors at play. And so this is what we're going to discuss today. How can we increase this interest by both companies and retail investors? And I think it's quite uncommon that we have a day like the day today talking about capital markets, and we do not have a specific panel on sustainable finance. But as the topic has been raised during the keynotes, and as this is an important, of course, an integrated part of the capital markets kind of topic, we will touch upon that as well. So let me see now, if I ask you, Marco, if I begin with you, I mean, in the keynotes we have heard about the initiatives undertaken by the European Commission and others to develop our European capital markets. But we also have a discussion in Europe today about what we can do at European level and what we need to do, if we need to do more at national level. We're having this kind of bottom-up or top-down discussion. And as an example, I mean, insolvency laws, tax laws, etc., are quite often regulated at national level, so it's only so much you can do. And Italy is, of course, one of the large EU member states. And for some reason, we have two Italians, Mario Draghi and Enrico Letta, who have been drafting reports on the way forward for the Capital Markets Union. And so may I ask you, I mean, as a kind of a background and your views on what you have heard here today about capital markets in the EU, but also, of course, in Italy, to take that example when it comes to fragmentation, infrastructure, etc. What does it look like? And do you think on the retail investor side in Italy, and when it comes to companies in Italy, can you say something about the interest in capital markets on their side and what the alternatives could be for an Italian company or investor?
Yes, thank you. First of all, I think we do have, generally speaking, a fairly unique alignment of positions that we have witnessed also here this morning. As in few other periods that I can remember, we have had policymakers, regulators, intermediaries, listed corporations, scholars argue that given the essential protection of the integrity of markets and investors, we do need to render the regulatory apparatus more friendly and more flexible. And this in itself, I think, is extremely important. At the European level, we have seen, in fact, some very important initiatives that I believe do definitely go in the right direction. The Listing Act is a perfect example. I guess not everybody, but a lot of people here in the room have been working in different capacities toward that. Just to make the reference a little bit more concrete, just think about the possible innovations with respect to market abuse and the simplification of the rules concerning disclosure. It's kind of symbolic. So this is, I think, extraordinarily productive for all of us. However, the elephant in the room, I think, as you mentioned, the Letta report and the Draghi report, is to move more decidedly toward a capital markets union. I really do believe that it's it's extraordinarily simple at one level. We have, 40 markets, around 40 policymakers, regulators at the national level. Just look at the actual rules. My father is an engineer. If I have to explain to him even just where to find the actual rules that apply to a specific issue, I am a lawyer. Sometimes if it's not something that I deal with every day, I might need easily 1 hour just to locate in between, the different levels of directives, Q&As, and so forth, the actual rule. That's not tenable. In the US, there are basically 2 markets and 1 regulators. We should go in that direction. And let's be clear, will there be winners and losers? Yes. But it's probably better to be, aware and somehow active in pursuing this, in trying to do this, ensuring distributive justice. So that, just with respect to markets, definitely all regulators and policymakers and legislatures also at the national level are moving in that direction. In Italy, we are working on a reform of our comprehensive law that also is interesting. I am a member of the commission together with others. And finally, you were asking about retail investors, which is another fascinating, I think, phenomenon, because we have seen, largely due to COVID and due to these things, the fact that a lot of people sitting on their couches at home have started, being more active. But that really creates a number of differences because combined with social media, it kind of start having a kind of social, if not political, also connotation, which is interesting also from a regulatory point of view. Think about, once again, when we talk about market abuse, and we have this notion of a reasonable investor to decide whether the information is price sensitive or not. Well, what is now a reasonable investor in the light of the fact that some investors, retail investors specifically, do not only pursue strictly economic and financial goals, but also other goals. So that's another, I think, fascinating phenomenon that we will see where it leads.
Thank you very much. No, and I think, as you say, we have in the previous day discussed in our meeting in ICSA, we have discussed finfluencers and etc. And I think that is a really important topic, how we reach out. And Paulina, you mentioned the financial education, etc. And as we spend quite a lot of time on that and efforts on that in Sweden as well, it's sometimes difficult as young people tend to go on apps and they deal in crypto assets 24/7. And then investing, of course, in the real world is something slightly different. So thank you for that. And Adam, now moving to you. We're kind of moving from the center of Europe to someone now who has an overview over all of Europe, both the UK and the EU. And you also publish an excellent report as AFME on the Capital Markets Union and different KPIs. And so before we kind of leave Europe for a little while, from your perspective, how do you look at Europe, the capital markets here, where we are, what could be done better from your view and the view of AFME, but also, of course, comparing ourselves then to the rest of the world?
Thank you. A lot of questions. I think we could have a long discussions on all of these, but let me mention a few observations. So indeed, in our reports, we are trying to look at longer-term trends as well as shorter-term issues across Europe, and I mean geographical Europe. One observation I would share, and I think some of the keynote speeches already made mention of this, is that Europe is underutilizing its potential, or its potential in capital markets financing is not sufficiently exploited. What we see in the longer term is that Europe is losing market share in terms of capital markets activity. I would just mention one number. From 2000 until 23, so in nearly 25 years, the market cap of equities, the share of Europe has decreased from about 19% to 13%. And if you look at individual member states of the EU, or if you look at the UK, you see a very similar trend. So it's a declining trend. What we see as a key issue is the market fragmentation, which is still prevailing in Europe. And of course, this has not been helped, to say the least, with Brexit, which meant that a further major fragmentation occurred in Europe. And just to give you an idea, Marco already made reference to some of the numbers. I happen to have the statistics. In Europe, which includes the European Economic Area, the EU, Norway, and some other jurisdictions, Switzerland and the UK, there are 35 listing exchanges as of today. There are 41 trading exchanges, 18 CCPs, 31 CSDs, and 14 local currencies. So this is the landscape we have in Europe now. And if I mention how many insolvency rules and corporate laws there are, how many tax regimes there are, we are talking about similar numbers, if not higher. So this is a major issue which leads to an underutilization of what Europe could offer. Now, you asked the question, what could be done? And I think all of the keynote speeches mentioned key elements and key measures that can help. So I will inevitably repeat some of them. One thing what Europe could address is liquidity. Liquidity in itself, market liquidity in itself, should be a policy objective, because market liquidity, especially secondary market liquidity, leads to more attractive primary markets and leads to better valuations. One of the other observations we are seeing now these days is that a lot of European companies across the whole EU, across the UK, they are choosing other jurisdictions to list or to move their listing to other jurisdictions simply for the reason of better valuations which they can achieve. And I would not quote individual firms or individual numbers because they are widely discussed in the media, but these differences can be significant. And some of even the largest national companies are thinking of moving to another jurisdiction, mainly to the US market to list. Now, if in Europe, with all the regulatory measures, we could increase liquidity, And it's not a zero-sum game. I completely agree with Paulina that we should not fight about sharing liquidity. We should fight about or discuss how to increase liquidity overall. That could lead eventually to better valuation for European firms and better access to capital to the whole value chain from startup all the way to large companies. So that's one measure. What do I mean by focusing on liquidity? Is the market structure reforms, processes, consolidation of the infrastructures, and so on and so forth. The second thing I would mention, and again, this has been discussed very broadly, is retail participation, and most importantly, the pension systems in Europe. It's very fragmented. There are pools of capital here and there in different countries with different taxation models, different schemes combining Pillar 1, Pillar 2, Pillar 3 pensions, whereas in other markets, most notably in the US, there are large pools of capital homogeneously available to invest in capital markets. So that's another big policy objective, which has got a massive upside potential in Europe. The third one, I already referred to it, and Marco mentioned it, is the integration of infrastructure, either in the form of mergers or better interoperability. The fourth point I would make is taxation, and there are already positive measures in Europe. For example, right now, administering withholding tax cross-border in Europe is a little nightmare, to say it very nicely. There are measures now trying to address this, very positively supported by the industry. These type of things could mean a lot of potential progress to improve the situation. There are other areas as well, but in the interest of time, I would not go into it until we maybe have a second round to reflect on each other's comments.
Absolutely. Thank you very much. And with that, I think, we will come back to some of these topics, and I think you're raising many interesting points here. If we leave Europe for a while and we go to Japan, which is, of course, also a major capital market in the world, and also the founding father of ICSA. So thank you so much to you and your association. Without you, we had not been here today. And I wonder there, I know that you have, you're working a lot in Japan, both in your association and your membership, but I think you also have a very good relationship and dialogue with your authorities and the Ministry of Finance and Supervisor in Japan. Could you please describe to us who are here a bit about kind of what the structure is of the capital markets in Japan, and on the similar way as we have talked about here before, the interest of retail investors and capital markets in going public, investing in the public, and also what the alternatives are for Japanese households and families.
Okay, thank you, Ulven. In Japan, the capital market, the household financial assets amounts to 2,100 trillion Japanese yen, which is equivalent of the 14 trillion US dollars. And more than half is cash and deposit. Even the interest rate is kind of nearly zero. So that was the problem for the government as well. So the government has been trying not very hard, but trying to transform this situation and using the slogan from saving to investment for as far as I remember, it's this 30 years or something. But it didn't work so much. But recently, this situation has begun to change. And Japan has taken 3 important measures, and these efforts has begun to change people's mind, in my opinion. And first effort is a tax exemption for individual investors called NISA program, which is a Japanese version of British ISA program. So, and we expanded tax exemption more than double, say from $5 million US to $12 million US from this January. And we shifted this exemption from temporary measures to permanent measures. And encouragingly, the reform have already increased the public awareness substantially. The number of newly opened NISA accounts with the major security companies was more than 3 times higher than the monthly average compared to last year, and purchase is the same 3 times higher. And if you see the Japanese TV every day, they kind of broadcast the explanation of NISA because the people are so much interested. And second effort is establishing the national organization, say the Japan Financial and Economic Education Center, which has a legal mandate to improve the financial literacy of Japanese public. So this new organization is a drastic concerted effort by the securities industry and the banking industry and Bank of Japan and the Financial Service Agency. And these organizations are committed to offer substantial financial and human resources. And JSDA is going to send 18 people to this organization. The hope is that better informed individuals who understand the importance of asset formation will use the NISA as a tool for long-term, diversified, and accumulative investment, and eventually leading to a virtuous cycle of for the capital market. And third effort is corporate governance. So in Japan, the corporate governance reform have been the main driver of attracting foreign investors. Last year, the Tokyo Stock Exchange requested listed companies to first analyze the current company situation, and second, formulate and disclose an improvement plan, and third one, implement initiatives for realizing corporate management that is conscious of market variations such as PBR and cost of capital. And furthermore, the exchange has started to publish a list of companies who have disclosed such initiatives. And these measures seem to be well received both domestically and internationally. So, thank you.
Thank you. Thank you very much. And well, we can tell that you are doing a lot, and I think the NISA is also a very good example of how we can learn from each other. I mean, in Sweden we have the investment savings account, and I think we've had that for quite some time, and I'm quite sure that at the time that they developed that initiative, they of course looked at what they were doing in the UK and in the US, of course. And Peter, I mean, with your everyone now is kind of pointing to the United States, the kind of perfect capital market in the world. In a way, you know, as Europeans in the old world, you know, sometimes it's good to learn that, well, there are some regulatory challenges, etc., and political ones in the US as well. But I mean, with your, from your kind of viewpoint in Washington, when you listen to all of this, I mean, it seems like in the US, we have lots of things in place. You have the 401ks, etc. I mean, but we also have, you know, financial literacy issues, etc. Could you tell us a bit about the US? Could you bring us up to date to kind of where you are? And also, of course, with your background in the UK, your knowledge about the EU and the rest of the world, can you say something about the US capital markets? What is it that what is it really like? And if you have challenges, please tell them to us so that we can go from here and say that, oh, we're not the only ones having challenges.
Okay, well, thank you, Urban. It's a pleasure to be here today and to represent the United States, albeit with a Scottish accent. I mean, I think the US success story in the capital markets is pretty well documented, and I don't really think anything is likely to change that soon. I mean, I think the most popular statistic that we at SIFMA, the association representing the capital markets in the United States, often use is this split we have in the US in terms of investment financing, where approximately 70% of it comes from the capital markets, and about 30% of it comes from the banking sector. And I think it's commonly known and understood, we certainly say it enough times, that if you look at the European situation, I think that tends to be flipped. And even within, debt financing in the United States, about 75% of that is from the fixed income markets, and only probably about a quarter of it from the banking sector. So, very much a kind of different dynamic in the United States. And I mean, of course, that's, looking at the supply side, and I was really pleased to hear, both Polina and Adam reference the kind of retail side of it. And I think that's also an important dimension in the United States, where I think around about 54% of households own some form of equities, which I think is a significant issue on the demand side. And I don't think it's a coincidence also that that structure in the United States and the vibrancy and importance of the capital markets correlates with this, I think, this pattern we see time and time again when the world economy goes into a downturn. The United States tends to experience that on a more shallow level, and when things start to pick up, as I think we're seeing right now, if you kind of look at the global comparisons of how economies are growing, the US tends to be at the vanguard and is growing the fastest. And as I say, I do not think that is a coincidence given the structure of the United States and the financial system. And that's also borne out in I think the finance minister earlier made reference to the Global Financial Center Index, which tracks the global financial centers of the world and sees which is the most attractive, which is doing the best. And obviously New York is top of the table in that league. I don't think that's a surprise to anybody. But it's not just New York. If you look at the top 30 financial centers in the United States, I think about 5 or 6 of them in the world, 5 or 6 of them come from the United States. So it's not just New York, there's Boston, Miami, San Francisco, Los Angeles, even Washington, D.C. is regarded as one of the key financial centers in the world. And that, ironically, the United States is also one of the only economies, I think, that doesn't really have an agency or some private sector conglomerate organization that looks to actually promote it as a financial center. A lot of other parts of the world do. We do not have that in the US. The success is very much, generic. It's kind of organic, and I think that's something we're very, very pleased of. Now, that said, when you have continued success like the United States can champion, I think there's always the risk of complacency. And the world is a fast-moving place, and it evolves. And one of the things that we have been concerned about at SIFMA over the past few years, our key regulator is obviously the Securities and Exchange Commission, the SEC. And one thing that we have been wrestling with, as have our member firms, have been the volume and speed with which the SEC has been producing new draft regulations and finalizing and also implementing new regulations. So it's just the sheer volume at which the SEC has been throwing things at the industry has really been quite significant and a big challenge for us. And if you just kind of look, briefly at some of the figures, if you kind of take a look about the first two and a half years of this SEC commission, which took its seats in 2021, it's come out with about twice the number of proposals that the previous 2 SEC commissions did. But it's not just the amount of proposals that it's putting out there. It's very important the industry have the time and the space to reflect on those proposals and offer quality feedback. But we are getting about 20% less time to reflect and give proper quality comments to the SEC. And this is an ongoing process because as the SEC are proposing more and more, some of the things they proposed early on in the life of the Commission are, of course, now at the finalization and implementation stage. So as we went into 2024, we saw that our member firms were, dealing with the implementation of around about 19 new rule sets all at once. So, that is also a significant burden. So that is something that we are certainly concerned with, and certainly have kind of done a lot to try and communicate and alert kind of US policymakers about. Now, you kind of mentioned obviously there's an election in the United States this year. I think everybody is very, very aware of that. If you're not sick about hearing about it already. This is an election unlike, say, 2008 or even 2012, where I think the role of the financial sector was perhaps more predominant in the wake of the financial crisis. That is obviously no longer the case. But I think where the financial sector comes in the political dynamic in the United States and could be affected by policy shifts is more in terms of second-order effects. And to give you an example, if you think about the direction of trade policy in the United States, where both parties have been looking towards kind of more restrictive trade policies and perhaps inching away from the post-war consensus of openness and liberalization, I think that is something that could impact the financial system and the financial services industry, primarily through the impact on client firms, but also potentially directly, because let's not forget, trade policy can be important for the financial sector also. And then there's other channels as well. Personnel is a huge issue in the United States. The work of the Federal Reserve, and not just in terms of its work on financial stability, but in terms of monetary policy, obviously have huge ramifications for the financial system. And I think it'll be closely watched how that evolves over the course of the election, regardless of who wins and what appointments are made. So I think those are the things on the frontier of the financial sector, what's kind of on our minds. I think the issues of regulation and those types of themes, which were really the prevailing themes in 2008, 2012, they are, I think, slightly more on the back burner in the political arena.
Thank you. And I think we will, come back to the issue about kind of regulation, over-regulation, etc. As this seems to be a common theme. And I'm turning to you now, Paulina, saving you the best for last, as they say, in this round, but also because, in the European Commission, you have lived through the CMU action plans. You have also, of course, in your present role, you're working with and you're responsible for the dialogues that the European Union has with a number of jurisdictions, including the US and the UK. Can you tell us a bit more about those dialogues? What's on the agenda, but also from your perspective, kind of taking a global view on the capital markets developments, because you have already mentioned that the Commission is doing quite a lot. We have European elections coming up, as you mentioned, and for you, kind of in waiting for your new boss, what can you do, and what are you doing to prepare for the incoming commissioner?
Thank you, Urban. And where to start? There's a lot of topics there. No, first of all, I think these international conversations and discussions are really, really important. Of course, we speak a lot about the complexity of financial regulation in general, and I will get back to that because I have a couple of comments on that. But I think that what's important here, of course, also is that we have our multilateral bodies, which I think haven't been mentioned here yet, although we are a very international crowd. And I think about the Basel Committee, I think about Financial Stability Board, I think about IOSCO, and I think that is really, really important. Some of these bodies clearly took on importance after the global financial crisis, but I would kind of dare to say that they are, probably as important today with the challenges we see in the world. With some people would even go as far as speaking about deglobalization. We speak about fragmentation within Europe, within our capital market, but we clearly, of course, see a fragmentation which is much, much broader than that. So I think having these multilateral conversations are very, very important, and I think this idea also that we do agree general principles, a general framework at the international level, and then of course each jurisdiction tries to deal with that and implement that nationally. And I think that this is something that we should be kind of cherish and realize that this is actually a strength of the international regulatory order in financial services. So that's a little bit the multilateral side of things. And then you mentioned, Urban, our dialogues, and these are bilateral dialogues that the European Commission is conducting with a number of jurisdictions. Ideally, we should do it with the whole world, but that would be a little bit too resource intensive for my little team. But we have established dialogues with Japan, with the United States, of course, with the UK, since relatively recently, of course, following Brexit and some of the complications there. And then we have a dialogue with Canada, and then, of course, in more ad hoc formats with some other countries. And it is really useful in terms of what we discuss. Of course, often focus on the macroeconomic situation, but also taking stock of capital market legislation, banking legislation, Basel implementation now being a big issue. This is a capital market conference, not a banking conference, but obviously an issue, as many of you are aware of. Sustainable finance, clearly something that we always discuss. Also digital finance, I think in both these areas, and that was mentioned by Dr. Perch earlier also, I think the EU is been relatively advanced. We have put in place sustainable finance framework, and we can get back to the complexity of it, but I think the framework is there, allowing finance to flow to green project, to sustainability, to finance transition. And the other area where I think we've done quite a lot is, of course, the digital area. And MiCA, so the regulation of crypto assets, have been mentioned. We've also recently agreed the Artificial Intelligence Act, which is cross-cutting, so not only financial services, but including financial services. And we have done quite some work also on operational resilience, our so-called DORA framework. And all these issues are, of course, all these are global matters. So it's great that we do things in Europe, but we need to have this international discussion and conversation about it. And again, I think it goes back to the idea of global standard-setting bodies, where we then all can try to take inspiration and follow these globally agreed standards in what we implement at home. If I may, but just very, very briefly on the issue of complexity, and by the way, I think what Peter was saying about the US and some of the challenges that you perceive and your members perceive, I think that is useful, because sometimes I think there's a perception in Europe that in the US everything is very, very simple and straightforward, and of course we all have our challenges to deal with. But on the issue of complexity more generally, I think that, two dimensions to that. One is that financial markets are complex today. There's no way around it, in the same way that the whole world around us is very complicated. If anyone has looked at the recent piece of telecom regulation, that I assure you that's very complicated enough as well. And it's not to say that we should be complex for the sake of being complex, but it's just to say that we are trying to regulate very, very sophisticated and complicated evolving matters. And I think it's a little bit almost inevitable that comes with a certain degree of complexity, which we of course need to try to reduce, need to make sure that rules are fit for purpose. But I think going back to a world where financial service regulation was very, very simple, I just think that is something of the past, and those times will not come back. A second dimension here is that very often we hear the calls to change things, to reduce complexity, to do things differently. And I think this is a really important conversation. I think from the Commission side, we are very attentive to the stakeholder concerns that we get, and I mentioned that previously in my keynote speech as well. At the same time, I think sometimes we should be a little bit careful, because every time you open legislation again, then you start a new process, and these processes can often be quite long, they can be quite burdensome, and in the end, maybe the result is, again, it may be less complicated in some ways, but more complicated in other ways. So I think sometimes it's also maybe useful to live with what we have, let the rules settle, let stakeholders get a little bit used to them before we always immediately have the kind of reflex to kind of embark on a new regulatory journey, because it is we know by experience that is often a little bit complicated, and in the end maybe always getting new rules undermines a little bit legal certainty and legal predictability. So a little bit living with the what is sometimes maybe better than always wanting to kind of change everything. But I will stop there. Thank you.
Thank you, and I think you have already now kind of started the second round or a half round about, as you say, better regulation, and it was mentioned, even here Dr. Putsch, mentioned the fact that you have was it 52 or 53 kind of level 2 and level 3 acts to DORA. And I recall with MiFID, kind of the main legislative framework that we have adopted here for securities markets in Europe, I think when the Commission proposed it, there were some 50 or so delegated acts included, and when the negotiations had been wrapped up, it was more than double that number. So even though perhaps the industry may not always agree with the Commission's proposals, I think the process that we have in Europe with member states and parliamentarians chipping in may not always help when it comes to the details. And of course, and I think we can also see from the industry that when it comes to reporting requirements, etc., at least I can sense a certain fatigue amongst our members, at least, once you have a report in place or whatever. They don't really want to open it up because, as you say, you never know what will come out of it. And I think the Commission has an initiative and an aim to reduce reporting obligations, regulatory burden. But even if you were to propose something like that, you never know what the final outcome would be. And I say, Adam, turning to you, when it comes to the complexity, I mean, you've been around for a while, you've seen this financial services industry from both the public and private sector. I mean, on your experience, and I will ask the others the same, I mean, as Paulina says, I mean, world has become complex, financial markets are complex, but what do you see, I mean, regulators, the proposals that we get, we talk about retail participation, at the same time we know that lots of the information that consumers receive is unbearable to them, they won't read it. So where do you see kind of this balance between complexity, perhaps we were talking about principles-based regulation once upon a time, I'm not sure we will get there, but also this discussion now about reducing the regulatory burden. You have the KPIs, etc. Do you think there is room for improvement in Europe when it comes to this?
Certainly, I think that's an easy question. There is room for improvement, but I think the real question is where this improvement could come from. I agree with Paulina that we are part of a very complex industry, which is very innovative and evolving very fast. So I think it is probably idealistic to think that we could go back to extremely simple rules. That's probably not something that is achievable, but certainly we could come to simpler rules and sort of more consistent rules with more certainty and more time to reflect and implement there. One interesting area, and I don't want to go into legislative details, but one interesting question in Europe, this is particularly with the complexity of the European Union as a whole, is what is defined in detail in level 1 legislation, i.e., which is sort of Parliament and Council co-legislative processes, and what is delegated to a lower level of regulation, i.e., Commission delegated acts or level 2 measures. What my impression, and this is one source of the complexity and the difficulty, one area where I think Europe could improve is to reduce the detail in the level 1, in the highest level of legislation, and establish some key objectives, key principles, and sort of KPIs or expectations for the outcome, but leave some of the more details to a lower level of legislation. That could probably reduce this complexity and the time of reviewing everything and changing it every now and then, and increasing the number of processes. When you mentioned the number of initiatives of the SEC, in the US. That's not very high by European standards in terms of the number of issues the industry is responding to. But I think with that sort of change of philosophy, there could be a significant simplification of the entire body of legislation. Sustainable finance is a case in point where I think the European Union has gone ahead very ambitiously with a broad legislative agenda and achieved a lot of sort of milestones, significant points. But the general feeling of the entire industry is that we need to sit back now, take a deep breath or two, and try to focus on the implementation of this, and only touch it when and if needed, but not to revise it too frequently, because it will just imply an impossible burden on firms as well as the financial system. So that's I think what the target should be, not necessarily to have very simple regulation, but sort of simplifying the process of changing or revising them and putting it into implementation.
Thank you. And no, I agree. And when Marco, I mean, looking at this both from your perspective from Bocconi as a law professor, but also, of course, as chair of the Italian association, and you were referring to your father, who as an engineer, I would assume can understand and deal with relatively complex matters. And then we're asking consumers to try to understand, and we will come back to the kind of sustainability, sustainable products, etc. in a while. But how do you look at this? I mean, as Adam mentions, the simplification versus dealing with complex matters, which is not really uncommon in law as well. I mean, you can have simple laws also, dealing with relatively complex matters.
Well, if you take a historical perspective, the law has always gone a little bit like a pendulum. Now, complexity increases, and then it reaches one point where it's really too much, and there's a reaction, and so forth. But there's no doubt that the facts and the businesses and the needs that the regulation in this area tries to address are extraordinarily complex, and therefore I agree it would be unrealistic to expect that we now all of a sudden move toward a kind of principle-based regulation. That's absolutely almost obvious, I would say. What I think is simple, however, is to realize the exceedingly complex and somehow irrational structure in terms of sources and in terms of application. And let me give you a few examples. First, an extraordinarily humble proposal. This is just by, why don't we have a consolidated law of financial markets in Europe? I'm not talking about changing any actual rule. I'm just talking about putting them together in a physical or electronic booklet where you have the part that regulates investment funds, the part that regulates financial services, the parts that regulate listed corporations. It's boring. You might say, well, it's not. But just by doing that, I think that not only people that are expert in the fields, but also people that are indirectly interested in the regulation would get a much clearer view of what's out there. And maybe it might be a first step to even improve something. Second point, every, I think, regulatory system, not only in the world across different geographies, but also throughout history, has had an approach with legislative sources, primary sources, and regulatory sources. I might be oversimplifying this. It's not that I'm not aware of the, I think, exaggerated issues with the Moroni doctrine and so forth. and the political problems, and I'm aware of the fact that probably we would need a different governance for ESMA, but why can't we have, a legislation that we know it has different levels in Europe, and then one supervisory authority and regulatory authority that simply directly makes the rules that transform this. I mean, this is, the way it works everywhere. And, one final point, which is connected. Too much regulatory competition in many ways cannot work properly in Europe for a number of reasons, including, frankly, language barriers. In the US, for corporate law, it's considered to be the genius of American corporate law. But I don't have the time, and you don't have the desire to go into the details of the underlying conditions for having regulatory competition possibly lead to efficient and fair solutions. We don't have that currently in Europe for a number of reasons. And one form of, let's say, gold plating, to use an abused expression, or hidden gold plating, has to do with the way in which rules are applied and enforced. Take, again, it might be my fixation, but market abuse regulations. It's one of the most highly harmonized rules and set of rules in Europe. The rules are exactly the same. It's a regulation. It's also a topic in which scholars, lawyers discuss internationally quite actively, so we are aware of the problems. Then you look at the reports on sanctions, and you see very different attitudes. I don't remember the numbers exactly, but in Germany and France, basically few sanctions each year, average amount of the sanction fairly high. 15 sanctions, 200,000 euros, the average sanction. You see, look at other countries, including Italy, average number of sanctions each year, 90, average value, 10,000. Now, I don't think that the conducts are radically different in France, Germany, Italy, Spain, and Portugal. So there might be a different attitude of supervisors, and that's a problem. And that's a problem because it's inefficient and it's unfair for especially international operators, but not only.
Well, thank you. And you refer to kind of one single rule book. And I think when I was in Brussels, when we were after the financial crisis, we had Dodd-Frank in the United States, and I think we all looked with envy at Dodd-Frank. Perhaps not at the exact content, but the fact that they were dealing in the United States with one rule book, while we were working in parallel with a number of different regulations and directives. We hear that you are frustrated, of course, with a number of new rules coming out of the SEC, etc. But do you also in the United States have the discussion about simplification, better regulation? I remember as a young lawyer working in New York in the mid-90s, when I was doing securities filings in the different states, and there was reference from Dr. Putsch about this DORA guideline, or even a level 2 measure about the size and form of a content of a form. I remember, at Skadden Arps where I worked, we had a full cabinet with the papers, the kind of, that we were to copy our, submissions on, because you needed different formats, you needed different holes, etc., depending on which state you were going to do the filing in. So each state had their own specifications. So from that point of view, of course, also that kind of templates or rules are good. But do you have the kind of simplification discussion in the United States as well?
Yeah, I think it's good practice, especially for advocates of the capital markets, to always be pushing to keep a fresh eye on regulation to see where they can be simplified, because as capital markets evolve and technology evolves, then it's going to make sense to kind of keep them up to date. And obviously, obvious examples, as we've seen through the pandemic, in terms of investors receiving their documentation in digital form versus in paper copy, those types of things, which I would kind of regard as a simplification. One thing I would just say, Urban, you held up Dodd-Frank as kind of an example of something that could be envied in its simplicity. I would just kind of qualify that by reminding you that we do have 12 or 13 regulators in the United States, which can introduce kind of more complexity, which actually we're seeing right now in the US. The US is trying to once again get around to finalizing its incentive compensation rules, something it's never done. And Dodd-Frank requires that to be the co-joint work of like about 5 regulators, and you have 2 regulators that have just reproposed it, and the other 3 have not joined on. So what that kind of thing means for the design and implementation and finalization of regulation is kind of anybody's guess. So we kind of have to deal with those types of things too, and then maybe we'll kind of come on to this in a bit. There's also the state level, which I'll maybe talk about in a bit later further on.
Thank you. So the sun is not always shining over the American market. Thank you. But when referring to the sun, and I mentioned sustainability, I think I would like to do a kind of a final round, as we mentioned sustainability here in the beginning, and it's of course important. I mean, we need capital markets to develop and finance the transition to a more green economy and a green society. And I know that this is something that is also of interest to retail investors. Hopefully we will have new companies that would like to go public who are active in the sustainability sector. So may I ask, take a round here. I know that in Japan there's lots of work going on to promote sustainable finance, and please, could you tell us about that?
Thank you. So I talk about the transition finance and the importance of transition finance to support effective CO2 emission reduction has been recognized at the global level, as seen in last year's G7 Hiroshima Summit communique. And Japan has taken 2 important measures to promote transition finance these days. And the first effort is the publication of sector-based roadmaps towards carbon neutrality. The sector means the power generation, like steel, or like oil, etc. And these sectors covers 80% of domestic CO2 emissions. And this publication is a joint product by the Ministry of Economy, Trade and Industry, and Financial Service Agency, and the Ministry of the Environment. And in addition to that, the government has developed follow-up guidance for financial institutions and institutional investors, which outlines basic concepts and key points for post-financing engagement by financial institutions and investors to the issuers. And these efforts are generally regarded as steps in the right direction to enhance the credibility and effectiveness of transition finance. And on our side, we at JSDA host a sustainable bond conference for market participants every year in collaboration with ICMA. And this year, the conference is scheduled to be held in a hybrid format in Tokyo on November 22nd. So we look forward to welcoming you to the event. And second effort is the government's issuance of the climate transition bond in February, this February, and which I believe the world's first sovereign transition bond. So the Japanese government has decided to issue 20 trillion yen, which is the equivalent of 130 billion US dollars of climate transition government bond over the next 10 years in order to achieve green transformation. And government hopes that the issuance of sovereign transition bonds would serve as a catalyst for further funding from the private sector, domestic and abroad. And it is estimated that more than 100 trillion yen, which is 1 trillion US dollars, in public and private investments are required over the next 10 years in Japan alone to achieve net zero emissions. So on the occasion of the first issuance of the climate transition bonds, JSDA released the chairman's statement to express the securities industry's commitment for the climate transition bonds, and we continue to support for transition finance as a high priority. Okay, thank you.
Thank you. Thank you. It's really good to hear. And Paulina, the kind of elevator pitch for what the Commission is doing in sustainable finance and what you can see coming up.
Thank you, and I will try to do this, the 60-second helicopter perspective here. The EU sustainable finance work has, of course, been mentioned by several speakers here. On the one hand, it is very complicated. On the other hand, it's actually very simple if we just look at how it's structured. So we have a toolbox, if you wish, of 3 building blocks, 3 building pieces, one being the taxonomy, which basically sets out how we, a classification of activities to promote sustainable and transition, by the way, investment. We have the second pillar, and it was referred to, the corporate reporting piece, really, really important. Sustainability reporting rules, which we have in Europe, and of course also been very active in the international conversations in the ISSB in particular. So that's the second pillar. And then the third pillar is our green, what I call our green tools, and that would be things like the EU Green Bond Standard, ESG ratings, and other kind of legal instruments that kind of help investors to finance the green transition. Now, these rules are a little bit complex. I think part of the complexity is also that the rules are new. So this is still something that I think companies need to get used to. I think the good news is that a lot of companies in Europe are very active in, first of all, in their own transition, their own net zero transition, but also active in financing the green economy, financing the transition. I think, but as a civil servant view, that there is indeed a need now for people to get used to these rules, for the rules to bed down. We have been working a lot with guidance to companies, with frequently asked questions. I think there's an issue of capacity building. There's an issue of giving support to smaller companies in particular. Now, small companies they're excluded from most of these rules in the sense that they don't need to, for example, do this corporate reporting. But of course, they are captured anyway because the big companies that they are delivering to in the supply chain will ask the smaller companies, the SMEs, for certain information. So I think there is clearly work to be done there in terms of capacity building, in terms of explaining, and in terms of letting these rules kind of find their place in the system. Transition, and that was referred to by Matuso, it's really, really important. I think in Europe we maybe started the discussion a couple of years ago a little bit too much already on what is green and dark green, but obviously what is also a really, really important conversation is the transition journey. How do you move from where you are today to a more sustainable place? And I think, and again, thinking about the global audience here, I think these are conversations that you're all having in your jurisdiction. Starting place may be slightly different, the regulatory framework may be slightly different, but I think that most jurisdictions are today actually battling with these same issues here. How do we finance the transition? How do we get from where we are today to where we need to be? And then finally, really 10 seconds, I would love to have another panel on how what level you legislate on. I think Marco is right that I think most jurisdictions in the world probably have some kind of system where you have, the primary legislation, and then you declinate that in more technical rules, more technical guidance. I think it is difficult to get that one right. It's maybe particularly difficult in a system like the European one, with the 27 member states, with our national authorities, with national legislators, by the way, sometimes also adding complexity to the EU rules. And it's interesting because on the one hand, I have a lot of sympathy with what you were saying, Marco, in terms of, let's try to have our regulators do a lot of that day-to-day implementation work. At the same time, you'll have other people saying that, no, we really want the legislator to keep as much control as possible. So it's a debate we've been having for some years, and I'm sure we will continue to have it, trying to find that balance and get it right.
Well, I think you will at some stage absolutely get an invite to a seminar or so also about that. And I think it's interesting, of course, as we have some, the securities law directive and other kind of interesting very, very legal kind of topics to discuss in the future as well. Adam, I mean, AFME, of course, is also active in this space when it comes to sustainable finance. Short, can you say something about your work in that field?
Yes, I think again, without repeating, I think in the EU, as Paulina mentioned and outlined, and also I referred to, I think the key building blocks of the regulatory framework are in place. So that sort of, in a sense, settled, and there is no expectation from the industry that there will be major new pieces of legislation coming on stream. In the UK, there is a little bit of lag with this, but it's expected that the UK will have very similar building blocks in the regulatory framework very soon. I think what is coming now is a massive effort of implementation across the continent and also beyond globally, and a lot of emphasis on the transition financing issue, because that's what is I think it's not yet clear how the whole regulatory and supervisory system will allow the industry and incentivize the industry to actually finance this transition path from brown to green. That will be the biggest challenge, I think, in the next in the next period. One other thing I would mention where AFME is very active, given that we represent the largest banks who are active in capital markets, is the supervisory space, because it's a new challenge also for the supervisory community to incorporate sustainability risk or ESG risk in a broader sense into the overall supervisory framework and risk assessment framework, and that in itself is a huge challenge for the industry, especially for the ones who have a banking license and they are very actively supervised in this place. So that's another area where we are putting a lot of collective effort to address data gap issues, to address methodology issues, to address risk management, internal risk management issues, as well as supervisory interactions in this space.
Good, thank you very much. And Marco, from your Italian perspective, I mean, we've heard about these efforts that are being made, and of course we have some challenges as well when it comes to complexity, but when it comes to sustainable finance, where do you find yourselves there?
No, I think it's, I mean, it's wonderful, it's necessary, it's right. I think we should all make a decided effort toward, not only, I mean, sustainable in all the senses, in terms of environment, of attention to social issues, and so forth. The only thing that is worth adding is that regulation is also, and we sometimes tend to forget it, one of the best anti-competitive mechanisms that is out there, especially when it comes down to competition of big enterprises versus small ones. There's, I think, a fascinating story of how labor laws developed in the US. There's this famous case of bread makers back in the 1910s. It's an extraordinary case because the issue there was a statute that reduced the period, the number of hours bakers could work each day from like 14 to 12. Who cannot agree? That's moral, that's right. But the one thing that is fascinating is that in lobbying and in litigating against this law, you would find against the small bakeries and in favor the labor unions together with the huge bakeries. No? So that's, I think, one thing that we should be careful of, together with the fact that there's this bet in many ways of ensuring, you want to do business here, then you have to apply our standards, even if they're not the same all over. It has both a moral component, but it's also a little bit of a gamble in certain industries. Maybe not so much in the financial industry, but in the industries that the finance works with.
Super, thank you. So, Peter, I will give you the last few words here. I mean, this is while we in Europe and the rest of the world refer to capital markets in the United States. I've heard at least Gary Gensler referring to what we're doing in Europe when it comes to sustainable finance. In a minute or so, what is happening and in the US when it comes to sustainable finance?
Well, I think in terms of the US, it really depends on how you measure it and what you measure. So if you measure, for example, at the federal level, where the SEC has really recently come out on its disclosure rule, that obviously, I think, takes the US a lot further down the path than it has obviously been in the past. It does not take it as far as the SEC initially proposed to go in terms of things like Scope 3 greenhouse gas emissions. That was excluded in the final proposal. And from an international perspective, there are kind of, international elements in there. It builds on TCFD themes and concepts. It does not, it makes some allusion to the notion of looking at equivalence, which is something that we always kind of embrace, but does not really give a definitive answer on it. But then, of course, compared to where the EU is, it really is a lot lighter on things like how it treats the supply chain, for example. And its scope is kind of much narrower, looking really quite specifically at climate as opposed to the broader sustainability agenda. Now, of course, the United States being the United States, the US Chamber of Commerce has filed a suit against the SEC and is suing them for going too far in this issue. But of course, on the other side, you have an organization called, I think, the Sierra Group, who has filed a motion to sue them for essentially absconding their responsibility and taking a step back from the initial proposal. But of course, the United States is called the United States for a reason. And there are 50 states, and those states have a lot of authority and a lot of power to implement their own rules and regulations. And that's really what we've been seeing in the climate space over the last few years. I mean, I think it's quite interesting. We had the pleasure of hosting Commissioner McGuinness and Polina and others a few weeks ago when they were in Washington, D.C. And I think it's interesting that, international visitors, are taking more of an interest in what's happening at the state level because of the climate agenda and what the states are up to. And that is pulling in two really contradictory ways. You have red states who are trying to impinge on the ability of investment funds and others to go in a new kind of ESG direction. And then you have blue states who are kind of trying to take a more mandatory approach and, for example, requiring it of public sector pension funds or whatnot. So, we're kind of really caught on that tussle. And we, as a trade association, think that ultimately this should all be up to the investor. The investor knows best. The investment advisor knows best. So, we are in a position where we have just filed a suit against Missouri, who they have required that if investment funds want to, go down this route and make investments in sustainable projects, they have to get written consent. We think that goes over and above their authority. That should really be kind of a federal regulation. So, we have kind of got our hands dirty there. And, then the election is coming, and, I think the Biden administration, if it gets a second term, will kind of continue in much the same direction that it has been going. I think there's bigger questions if there's a new Trump administration, a second Trump administration. It'll be interesting to see how they deal with things like the Inflation Reduction Act, which, on the one hand is a much more kind of interventionist approach on ESG issues, which I think from a Republican perspective, they probably will bristle with a bit. But at the same time, in this kind of era of kind of more nationalistic policymaking, it could kind of be seen as something which is championing US industry, albeit industry which is kind of grounded in the ESG space. So I think there's probably a tension there for the kind of the red side of the political divide. So I'm interested to see how that plays out.
Thank you very much. And I think that, just proves that we will have enough space and topics to discuss also at future panels about sustainable finance at the global level. Well, thank you very much. Apologies for taking a few minutes of your lunch. I think I would just conclude by saying that, lots of efforts are being made to improve and grow our capital markets. It's been really interesting and good to hear also from regulators and supervisors in the keynotes and in the panel that there is an awareness of the complexity, the regulatory burden, etc. But I think we're all sharing one single purpose and aim, and that is to provide good financial services and products to consumers and companies. So with this, thank you so much to the panel. I think we give them a big hand. Thank you so much. And now, looking at Michael, I think it's time for lunch. Yes, it is. Thank you so much for listening.
Dear friends and colleagues, it looks very much like you have enjoyed your lunch. But please take your seats here in the conference hall again, so we can continue for our afternoon session. I am very delighted and pleased and honored that the city of Frankfurt has recognized that a global delegation of dedicated capital market experts came to Frankfurt for the very first time, actually. And as an information, we have delegates and observers for, I think, 20 jurisdictions. And I'm very, very glad to welcome Mrs. Stefanie Wüst, Deputy Mayor and Director of Economic Affairs. I hope I did translate this correctly, of Frankfurt. And the floor is yours, and we are very, very glad that the city of Frankfurt recognizes this global audience.
Thank you. Dear Mr. Funert, dear Ms. Cliff Müller-Frank, ladies and gentlemen, it's the first time the high-ranking ICSA meeting takes place in Germany and Frankfurt, which is very much appreciated not only by the market participants, but of the City Council as well. It's a pleasure to welcome you in Germany's financial hub, and I hope you enjoyed your trip to Frankfurt. In the course of a 3-day global gathering, today's conference will give valuable insights on security markets and the maybe different perspectives of the supervisory bodies. Geopolitical tensions, trade disputes, and technological disruptions cast shadows of uncertainty, challenging the global financial systems. We need a deeper European capital market integration and cooperation to ensure sustainable growth and financial stability. Frankfurt, often referred to as the financial capital of Europe, has always been a center of stability. As a significant international financial center, Frankfurt owes much of its success to the capital market framework established by the European Union. The presence of the ECB and EIOPA, headquartered here in our city, play an important role in attracting financial players, especially after the Brexit. Together with Bundesbank and BaFin, ECB and EIOPA are in close dialogue with the finance industry and therefore ensure the stability, integrity, and solvency of the European capital and insurance market. But when talking about integrity and risk, we have to confirm that Europe is facing more and more terrorist attacks and financial crime. As a result, the fight against money laundering is a top priority for the European Union and Germany, and please let me add Frankfurt as well. Following the European Commission's ambitious legislative proposal, the EU will not only unify anti-money laundering legislation across Europe, the EU will also establish the Anti-Money Laundering Authority as the first ever designated EU authority to counter money laundering and terror financing. And as most of you might know, Frankfurt will become the home of EMLA. Germany's bid to host EMLA is a joint project of the German federal government, the state of Hesse, and the city of Frankfurt, under the leadership of the Federal Ministry of Finance. And we, as the city of Frankfurt, are very thankful for the strong commitment and support of the federal government and the state of Hesse in competing with other EU member states. When we presented together in Brussels, Finance Minister Lindner underlined that Frankfurt is the ideal spot of the agency since its major banking hub. He pointed out that this means that EMLA and its staff will be able to carry out their primary tasks, such as the direct supervision of Europe's biggest financial service providers, with greater efficiency and overall sustainability. Having the European Central Bank and EIOPA as a neighbor of EMLA will improve cooperation and communication between banking and money laundering supervisory agencies in short walking distance. Nevertheless, Frankfurt is not just a regulatory hub, the private sector is impressing as well. 280 banks are located here, thereof 170 banks are foreign. Many international banks have their European headquarters in Frankfurt. The presence of international banks has grown significantly in the last years. Almost 60 banks from 15 countries have relocated people to Frankfurt after Great Britain has left the EU. Many of them moved their European headquarters to our city in the wake of the Brexit. And we noticed that significant assets were shifted from UK to Frankfurt and jobs respectively. The foreign banks stand for around 60% of Frankfurt's banking community. And their balance sheets are sharply rising in comparison to the years before. They are leading in investments and asset management and stayed for 9 of 10 leading banks in Germany in these statistics. Similar situation in share placings and M&A transactions, brokers, investment boutiques and brokers contribute as well. And with the Deutsche Börse Group, we have one of the strongest securities market platforms in Europe on top. But what makes Frankfurt special is not just its status as a financial and insurance hub, it is also the vibrant mixture of industries, cultures, and talents that define our city. Frankfurt is a cosmopolitan melting pot where individuals from across Europe and overseas meet to work, live, and thrive. Our city's multitude of its population and visitors boosting creativity, innovation, and entrepreneurship. It is this spirit that feeds Frankfurt's success in attracting global businesses, fostering startups, and driving technological innovation. Furthermore, Frankfurt's strategic location at the heart of Europe provides unparalleled access to markets and connections to all corners of the continent. It serves as a central gateway for international trade, offering world-class infrastructure and a robust transportation network. Frankfurt's exceptional connectivity, coupled with its well-established, diverse ecosystem, has made it an attractive destination for companies seeking to establish a presence within the European Union. And finally, for expats and their families, Frankfurt am Main and the Rhine-Main region offer sufficient capacities and varieties of international schools, childcare, and leisure opportunities. With the vineyards of Rheingau and the Taunus Mountains, in combination with Frankfurt's theaters, museums, clubs, restaurants, and green areas, there's a lot of work-life balancing, attractions to feel welcome and at home. Closing my address, I would like to thank you for listening and wish you a challenging panel session, giving the floor to Mr., if I informed right, Rico Zhang, as the moderator. Thank you.
Yes, before we enter into the second panel session on T+1, which is really a very exciting and an important issue, let me still thank you, Mrs. Wyss, very much, and for your welcoming address. And may I add one last sentence? The city of Frankfurt would have been very happy to host a reception for us if we wouldn't have had a public holiday yesterday. So also for this, thank you very much. And yeah, that's what I... Thanks.
It's a great honor to moderate this panel. I think this is the last session for this conference. Hope you still bear with us, not too sleepy after the lunch, even though we have a very nice one. May I invite my panelists, the BBF's Utam Bagri, Clearstream, Dirk Losch, the Federation of European Securities Exchanges, Rainer Ries, AMAFI's Stephanie Hubert, and last but not least, SIFMA's Thomas Price, who will join virtually, actually. Great. As you know, T+1 being discussed recently as a really hot topic. Much has been written and spoken about the upcoming move in the US and a number of other territories to reduce the time between the trade date and the settlement date to a single day, as well as the likelihood that many other jurisdictions will feel compelled to follow. As you know, ICMA is active in both the UK and the EU discussions via the Accelerated Settlement Task Force in the UK and the Cross-Industry Task Force on T+1 in the EU. With 1 week to the go-live date of the US transition to T+1, actually on May 28th, I think that's the reason why Thomas Price cannot join us, busy preparing such reform. The narrative has mostly focused on the reduction of counterparty and credit risks and potential efficiency gains, particularly in the case of exchange-traded and centrally cleared instruments, as well as the logistical challenges and associated cost of modifying often complex post-trade processes that can involve numerous entities and span multiple time zones. However, what does this mean for trading, and how will it impact pricing and the liquidity, particularly with respect to instruments that are very much dependent on market makers and other principal intermediaries to support secondary market activity? To what extent will a shortened settlement cycle add to their risk and the cost of doing business, and how this will change behavior and the provision of price and liquidity? So we have full experts here and to really ready to discuss about this important topic. Maybe given the US is in the hot place, I give the first speaking role to Thomas online from SIFMA. So may I ask Thomas, is everything in check for implementation weekend? What have the discussion been with non-US based counterparties around the globe?
Well, thank you, and I do apologize. I wish I could be there, but as you suggest, with T1 right around the corner, that prevented me from travel. So I do want to thank you for the opportunity and to be part of this prestigious panel. It's really an honor to be here today. So thank you very much. To answer the question very specifically, this is not a new concept. We've been speaking about getting to T+1 since 1995. So really, this has been a 29-year journey. We followed Europe by going to T+2 in 2017. And we're ready to kick off the cutover, which actually starts on Friday evening, May 24th, where all the infrastructure will start dropping code after the close. In addition to the US moving to T+1, we have Canada, Mexico, and Argentina moving to T+1. But just to be clear on that point, we're moving the effective date for the US, as you may know, is Tuesday, May 28th. However, we do have a holiday on that Monday, next Monday, in the US Memorial Day. But Canada, Mexico, and Argentina will be moving a day sooner, which is that Monday, May 27th. We have done here is that we have a command center set up that we will monitor the transition. We have markets, the infrastructure, and the service providers all part of this infrastructure, which we start on Friday evening. We have over 1,000 participants included in this. And then, of course, we'll have regular outreaches to the regulatory community and policymakers through this transition weekend and week. And again, the goal of the command center is really be a central location for market participants to monitor the status of the transition, to address any frictions, and then to really triage any issues that develop over the weekend. The goal for us in the transition, I know there's been a lot of conversation around this, is to fail forward. So if we run into some glitches, the idea is to continue to push forward to meet the regulatory mandated by SEC effective date, which is May 2028. We'll have continuous, what we have done, to answer the second question, what we have done in terms of outreach to non-US based counterparties is there's been an extensive outreach campaign. This is one opportunity. We've spoken to this group in the past. In addition to that, we've held a number of webinars with the global custodians, where we had literally thousands of participants, both for the European and the Asian marketplace. And in addition to SIFMA working with other trade associations, we've had our members, the broker dealers and the asset managers, have had continuous conversations with their customers and counterparts. Again, I think it's important as you folks think through your transition to T+1, and again, in the U.S., it wasn't optional. We have a regulatory mandate to do this, which we will comply with effective May 28th. We feel at this point, in terms of talking to the members, understanding what their issues are, talking to the various different service providers, the infrastructure, the regulators, there have been an extensive amount of outreach. We believe that we're ready to go, and effective May 28th, Tuesday of next week, we'll be in a T1 world here in the US. Thank you.
Thank you, Thomas. That's a very comprehensive update about what's going on now in US. Let me turn to Europe then. The next one I will go to Dirk. What market players, in your opinion, are more prepared than others? And how can the latter step up their execution strategy?
Yeah, thanks a lot, Rico. And thanks a lot for inviting me to that panel. I thought I'm probably going to provide a little bit of an update from the machine room, being a representative of one of the CSDs impacted of that transition. So we are looking at two things, right? We are looking at the T+1 migration in the US, which is going to be absolutely in focus, and I fully understand why Thomas can't make his way here in the light of what's upcoming. And then we are looking at the T+1 developments in Europe, and also UK and Switzerland, of course. So we have been very busy over the last few months supporting our clients on the migration for T+1 in the US. And there were a lot of open questions at the start, so there has been a good reach out from DTCC and also from other organizations, but still there were a lot of open questions to clarify. So we have organized webinars, we have put together an FAQ document, a very detailed one, and what turned out to be the most important aspects were the cutoff times, so to what extent are they going to change, the FX capabilities, knowing that it has to be much quicker going forward, and of course the confirmation affirmation process, something the vast majority of the international community was not really used to. I mean, it is in place for quite some time, but it has not really been that present in the past. So we have developed a solution at our end allowing to support this process, either with the own ID or using our ID. And that was very important to the clients. Then the other very important aspect is the double settlement day. Next week, Wednesday, right? Because there's going to be the activity from Friday, T+2, and then there's going to be the activity from Tuesday, T+1. So there's going to be a lot of effort needed from a back office perspective, a lot of preparation to make sure that those double volumes are going to be managed in an efficient and smooth way. The other thing, and you might have read the same, is that the ETF industry all of a sudden was sending alarming messages around the fact that there will be some major reconstitution and rebalancing efforts right this Friday after close of business. And if you are an ETF and you are passive, you have to jump. You have no option to not do it, right? So there is going to be increased volume on top of the double settlement day on the back of those initiatives taking place. And then right after that, on the 31st of May, there's going to be the MSCI rebalance day. Again, another big additional volume to be expected on the back of that. So there's a lot of preparation going on in regards to that. But looking at this from a different player perspective, I think, the main benefit seen on the back of T+1 is that there's going to be reduced counterparty risk, less margin requirement, usage of new technologies, and of course, an alignment internationally from an overall market perspective. So what is the role of the key market players, right? So we are looking at CSDs, we are looking at exchanges, at CCPs, at broker-dealers, we are looking at institutional intermediaries, and we are looking obviously also at investment asset managers and investors. And depending on what role you have in that value chain, it's going to be a different kind of impact. So for us as a CSD, the impact is expected to be quite limited. So we are supporting our clients to prepare, but we can theoretically in our environment settle T+1 and even T+0 today already. So we see that on a daily basis. So it's technically possible. But looking at it from an exchange perspective, for example, also in Germany, the exchange is open until 10 o'clock in the evening, whilst the overnight settlement run in Target 2 for Securities, a pan-European settlement platform, starts at 9 o'clock CET already. So there will have to be done something, right? So either you start the overnight settlement day later, or you have to close the exchange earlier, but both in combination is not going to be possible. So that is one implication which is going to be taken care of. And then, of course, the geographical view for the counterparties in Asia, it's much more difficult than it is for the market players in Europe and especially in the US. So we have a lot of dialogue with the clients in Asia, and a lot of them have decided that they're going to have additional staff in the US for the start, but maybe even in the long run in order to support this business activity, because otherwise they wouldn't have seen how to manage it. And then, of course, we had this sample of the bakery earlier. The size of the market player makes a big difference, right? So the expectation that the technology is going to become better because you're forced to do something works probably pretty well for big institutions because they have the scale and they have the investment budget to do it. For the smaller ones, it's going to be very different because it's been very difficult to do all of those investments in a relatively short period of time. And then I think we also have to look at what is the industry we are looking at. We are talking a lot about digitization, distributed ledgers, and all these good things. And then I look at the fund industry, which still works with faxes even today, right? So depending on where you are in regards to your current level of process, you have to do an either small step or a very big step in order to become more efficient in the context of T+1. And then maybe as a last point, we had also very interesting discussions with asset managers. So if you are selling in Europe and you're buying in the US, whatever it might be, a car manufacturer or a software company or whatever, you're going to sell today, you're going to get the money today in 2 days. So, right? So it's basically, you have to wait until in 2 days in order to get some money. But when you do the same investment same day in the US today, you have to pay tomorrow already. So you will have a day where you have the liquidity need and you have a dependency on a credit line or any other source in order to make that happen, which is also something which had not been really in focus at the start of the T+1 discussions and which has now been turned up. So in summary, I think it very much depends on who you are and where you are in regards to the impact in regards to the T+1 and the level of preparedness.
Thank you, Dirk. You basically describe a very overwhelming picture. Allow me to turn to Rina. So even this is so complicated, and as the EU cross-industry task force on T+1, what are the latest EU consideration even for a move similar to US?
Well, thank you very much for including me here on the panel. And I think, as Dirk already outlined and you just said, it's a very complex and demanding undertaking, I think, in Europe. So this European T+1 industry task force has gotten together since right at the beginning when the decision was taken in the US to move, and so it's in effect about a year, and I have to say certainly it has produced preliminary consideration, answer to the ESMA call for evidence on shortening the settlement cycle. It's now working on a comprehensive assessment what this will mean if the EU moves to T+1. And I think collectively they do agree it is complex, it's complicated, it's much more demanding than in the US, because obviously we're a much more fragmented market with many, many more market players, with many different national rules, with time zone considerations, and so successful migration really requires a lot of coordination, and that certainly means industry effort. It means, I think, a clear governance, and it means sufficient testing. We just heard that's happening in the US, but that is much more challenging in the EU because there's so many more infrastructures, so many more players that come to play. And I think the challenge here of transitioning in the EU certainly is that we will see a severe compression of the processes to one day, as Dirk just outlined. So a lot less time will be available. That will mean probably also, and Dirk just said that for the US, I think we'll probably see that in Europe as well, longer hours where people need to be present in offices to actually be able to manage everything. The costs and benefits are difficult to quantify, and I think that's also where the task force seems to be struggling. There are some that very adamantly push for a quick shift to T+1 and see very great benefits. There's others that are questioning whether the move is even worth it, and whether the efforts wouldn't be better invested in other areas in the European capital market. So I think that's a debate still out. What is the long-term impact on market liquidity and on overall functioning of the European market? Overall, and that was mentioned, T+1, yes, the FMIs can easily do it. So infrastructures are even prepared to T+0, but that, of course, would be a complete redesign. So I think there's broad agreement, I would say, across industry that that is nothing we should be even thinking about at this stage, because that would be an even more complex and more revolutionary approach that probably has even clearer benefit at this point. And I think then the other thing that really comes is that we should be moving between Switzerland, the UK, and the EU on one date. Currently, the second half of 27 is sort of what people are discussing or working towards. Why second half? Because certainly that's when less corporate actions happen and when it's probably a more feasible point. So obviously, again, from an exchange perspective, as well as I think the downstream side, it's not the big issue. It is more for the asset managers, for the intermediaries that need to facilitate that and to see that they are able to align their positions within a day, where currently they have two. And maybe that's where I stop.
Thank you. Let me turn to Stephanie, and also to share your view, particularly from the EU perspective.
Yes, so just to, you touched upon it, Rainer, but in fact, yes, there are questions as to the cost benefit of this initiative. We understand very well that it's a trend, maybe a global trend to a certain extent, and that speed is of the essence in our economies. However, we would like our EU institutions to ask themselves, why are we doing that? And to carry out a thorough cost-benefit analysis. We are talking about the when and the how, but we're not talking so much about the why. And at Amafi, we are wondering whether the cost, which will indeed be very sizable, will be offset by the advantages. In terms of collateral management, of collateral costs, we don't think that this is going to be a huge benefit because collateral margins on cash settlement is not the highest cost pocket at an intermediary. We are also wondering about the impact on liquidity, as both of you mentioned. And in terms of attractiveness, and this is where generally we are said that this needs to be done for the attractiveness of the EU capital markets. There is certainly a point, at least from a perception point of view, that Europe needs also to move to T+1. But we should also wonder whether T+2 could make sense, for example, for Asian investors. So Europe remaining at T+2. And also in terms of overlap with the US trading, would it make sense also to remain at T+2 to allow this overlap to be larger than what it would be if we move to T+1? So we are not against T+1, but we are really questioning as to why we are doing it and what are the cost benefits. So we believe that thorough analysis must be done and the obstacles lifted. And to us, it's very interesting to have the US move happening at the end of the month, because it will help identifying the problem areas. It will help us also see where are the costs, where are the actual benefits of the move. And just to finish, it may be this move to T+1 for Europe, because as you mentioned, in Europe it's a complex environment. We talked about it this morning. We've got 18 CCPs, 28 CSDs, 14 currencies. So it's more complex than anywhere else. So it may be a way to steer reform of the post-trade infrastructure in Europe. But is it the right way? Is it not a forceful, unplanned way to do it? Well, we need time, we need data before we set a date, I think.
Thank you. I think we face the same challenge in Asia, but India actually is quite advanced. It's already on T+1 and has recently introduced an optional T+0 instant settlement. So how has the market response been, particularly for the foreign portfolio investors?
So before that, just Indian markets, of course, are simpler because we have 5,000 listed companies. We have a single currency. All the companies are domestic listed companies. Our market hours are from 9 in the morning till 3:30. So that makes life much simpler. What India did a bit different compared to other jurisdictions is we did not move all our companies to T1 on the same day. So it was a staggered approach over 1 year. From the beginning of 2022 till the end of 2022, we listed all our listed shares in terms of market cap. And the smallest companies went in lots of hundreds and 500s every month. So that gave a market a lot of time to adjust. So by the time the bigger companies, the highly traded companies started coming in, the entire market knew how the systems were working. So apart from the UAT test environment, we also had the live environment. You test, buy 100 shares and see what's happening. For the domestic market loved it because we are in the same time zone. And this world is getting very instant, right? The young generation wants everything today. I'm not going to wait for 2 days, even 1 day. So at least from the domestic point of view, everybody loved it. We got margin benefits, right? People could trade more on the same margin because the settlement is done. FPIs, the foreign institutions had some problems. So even they found some nice ways. The Forex market in India was legally open 24 hours. from day one. However, nobody used to trade at the odd time. But the moment this started, banks started having their morning desks. I understand many Western-based foreign portfolio investors started using the Asian offices to handle India. So that also kind of, because they were awake before India. So this is how people kind of worked, managed. There are talks of T0 and Urban's favorite statement, T-1. So that's unlikely to happen. T1 is going to remain the main market in India. But my regulator experiments a lot. So we started a T0 optional settlement on the side, which was launched as a beta version only in 25 securities, to just prove that it can be done. So there were some sample trades, but then after that, no significant trades have happened. And the market is T1, it is going to stay T1. In fact, it is a stated objective of my regulator to stop this T0 and replace it with instant settlement. So in terms of instant settlement, you do the trade and the securities and the money will move in batches of 15 minutes or 10 minutes or something of that sort. So that is, these are the interesting things happening in India. For us, T1 is not a discussion. It was done back in 2022, 23, and it's fun watching the other more complicated jurisdictions going through the process. So we kind of leapfrogged, but that's where we stand.
Thank you. Thank you. Very interesting. So I would like to turn to Thomas. So Thomas, are you still with us? Yeah. So yeah. So is there a strong domestic view for the UK and EU to move to T+1 settlement?
Thanks for the question. And I think it's a preference, but I think there's a recognition that alignment is optimal. But however, right, a disciplined, diligent analysis of the impacts to market, liquidity, to your customer base, as the panelists have described here, I think is important. And with all due respect, it's, in our view, it's really up to the market participants in the UK and the EU to work with policymakers to determine what's best for your markets and your investors. So there was a report recently put out, I believe it was a Citigroup, that talked about and addressed the convergence of settlement cycles around the globe. And I thought that was an interesting piece. However, we really will yield to the European and UK participants to determine their own path. However, we would suggest, and I'm certain that this is happening, that you will learn from the US transition to T+1. And we stand ready to provide details and expertise as it relates to our transition. I do, in closing this part of the discussion out, I will state, as it relates to T+0, unequivocally, SIFMA does not support a T+0 environment. We don't believe that's optimal. We believe there's tremendous challenges with that. We're talking about the impact of liquidity and markets and market participants and the cost benefit in a T1 world. That only gets more complicated in a T0 world. So, and we don't believe the current infrastructure can support a T1 en masse. Now, there are opportunities to settle in T0, as you folks know. However, for the entire ecosystem here in the US, that's not something that we envision or support at this point. Thank you.
Thank you, Thomas. Let me turn to Dirk. How is the UK-EU addressing settlement fails related to the potential move?
I mean, settlement failures are at the top of the agenda for quite some time already. There's a CSDR regulation, and there's very close management of fails in Europe, inclusive of a penalty regime, which has been established not that long ago. And even now already there are discussions around how to make it even more expensive for those ones failing. So we are working a lot with our clients, and we have invested a lot of time last year through workshops and other means in order to improve the settlement rates, to understand what are the main fail reasons and what can be done about them. So we have been able to increase the settlement rate by around 40% by value, which was quite a big step. And I suppose that all the other CSDs are doing exactly the same in preparation for the T+1 move, because the likelihood that there will be more fails, at least at the start, is quite high, right? And you will be able to watch it, right? So the lack of matching instructions, the need for correction of SSIs, and missing information, plus dependency on internal processes. Those are the main reasons for settlement failures today. And those are not going to go away with T+1. Right? It's rather the opposite. It's going to be intensified for quite some time. And then we are back to how much can you invest in order to make your process more efficient, in order to make things SDP, in order to get away from it. But this is going to be a massive task for all the market participants in the future as well. So what do? So we support our clients with those kind of intensive deep dive sessions, and at the same time we're investing into data products to allow them more insight in regards to what exactly is the reason for the fails and how can fails be avoided. And at the same time we're investing into systemic capabilities like partial release, partial settlement, all these good things which can improve the settlement rate. And that is something we also witness others are doing exactly the same we do from a CSD perspective, and also from a pan-European settlement infrastructure perspective in T2S. A lot has been done in the past in order to improve the situation. What we are doing right now is we are working with the Eurosystem to also improve the cross-border settlement efficiency, just because T2S right now, I mean, it was supposed to be a pan-European settlement system, but what it really is a roof, and below the roof you still have more or less individual markets. You'll still have Germany, Italy, France, and all these markets settling like they did before, just under one roof now, but there's very limited cross-border activity. And that is because there's a limitation in the T2S system right now, which prevents that all the instruments can be settled cross-border the way they should. And once you start to discuss why a certain population of transactions can't be settled cross-border, it's not interesting anymore, because managing the exceptions would be quite too costly and to work intense, and that is why we need to fix that at source, and that is what the Eurosystem has committed. They're going to deliver a change next year in order to remediate that situation. So all in all, I think it's very important that we give sufficient lead time for this transition. We think it needs to be aligned between the UK, Switzerland, and Europe to all jump at the same time. And it should not be a staggered approach, because that would increase the complexity. And what a lot of people have also underestimated to a certain extent, I think, in the context of the US, is that there's a lot of trading taking place in Europe in US instruments. So in Germany, for example, you can trade around 4,000 US instruments plus another 10,000 bonds. And all of those are still going to be settled in a T+2 environment going forward. So if you had a setup where you had, for example, cross-border elements into or from the US, that is going to be significantly more difficult going forward, because it's not going to be aligned anymore. It's going to be a T+1 versus a T+2 settlement environment. And that is why there are a lot of market participants desperately waiting for this alignment, right? So you will have different perspectives. You will have the ones who basically would like to go to T+1 the day after tomorrow. And then there will be the other ones who will say, hold your horses, I like the T+2 concept, I don't want to move into T+1. And we have to find the right balance. So there's a lot of expectation now from ESMA to come up with a plan to explain to us how we should do this. I think it's very high expectations, and these will not be fulfilled to the extent probably some people wish they will be fulfilled, because we have to do some groundwork, and we have to do it together. So the financial market infrastructures as well as the market participants have to chip in and have to come to the table and discuss and work with ESMA to come up with a robust plan on how we can best move to T+1 in the European landscape. That it's going to happen, I think, is not really a question anymore. So there are still people challenging that, but I think there's a very strong political wish to do it. There are a lot of market participants pushing for it for the reasons I've just outlined. So from that perspective, I think it's going to happen. It's just a matter of when and how exactly it's going to happen.
Yeah, thank you. Talking about ESMA's position and also the settlement discipline, let me turn to Stephanie to maybe could you share elaborate on to us the ISMA's plan to update its CSDR settlement on penalty and buy-in in particular.
Yes, ESMA is due to prepare technical advice to the European Commission on the CSDR penalty regime. The idea is to increase cash penalties for failed settlements, to increase the deterrence effect of the cash penalty regime. But as you mentioned, this is quite a new regime because it's been implemented in February 22. So it's still very early to see if the effect is here or not. And I must say that's an important task and that ESMA has to execute here, because this cash penalty regime is like the last line of defense against the buy-in regime. And the buy-in regime is a regime which we are a bit fearful of. We wouldn't like to go into this buy-in mechanisms. I should have said at the beginning that AMAFI did welcome the CSDR cash penalty regime, because we think that settlement efficiency is very important to market integrity, market efficiency, and also to the attractiveness of a market. So as I said, it's quite early still. When we look at the French market, we don't see any market failure in terms of settlement fails. We looked at the month of April, last month of April, and at Euroclear the settlement fail rate was 2% for the French market in value. So there's no market failure as such. So we believe that we should take a look at the data, gather the data, and do it on a longer period to assess whether or not the penalty regime should be enhanced. And to a certain extent, it rings back to what the lady, the Director of General Affairs of DG FISMA was saying earlier on. Before amending a European text, we should make sure that we do have the basis, the rationale to do it, and we shouldn't make it too complex. In its proposal put to consultation, ESMA proposes to set up a cash penalty regime which we feel is complex for the market, with different factors to consider to set the penalty, factors which are not that easy to comprehend and to implement. So we are in front of something that could be quite complex. And finally, as you mentioned, there is the question of T+1, and the enhancement of the cash penalty regime could in fact be a mistiming with respect to T+1, because we do expect an increase in the fail rates. So the industry would be, in quite a difficult position if it were to happen at the same time.
All right. Let me turn to you again, Wooten. You mentioned about India's dual settlement system. So how does that ensure fair allocation and pricing? And has the market identified any risk of concentration?
So as I had mentioned, the dual settlement or the second settlement T0 is not adopted. Though it's on, in theory one can trade, but the bid and ask is hardly there. Having said that, the clearing and settlement has already been, has figured it out to a great extent. Just as a context, India is totally ID market, and we have already moved to segregation of client collateral ID-wise at the clearing corporation. So every client of mine, if he gives me $100, I would deposit it with the clearing corporation or equivalent assets and allocate in the name of that client. And it's being an ID market, when the client trades, it's that margin that gets impacted. Now, the clearings and settlement systems are designed in such a way that the same margin can be used to trade in any of the settlements. either you trade on T0 or T1, both settlements are open. Again, I'm clarifying, India is planning to stick to T1 for the foreseeable future. We are not moving the main market to T0 as per the current regulatory plan. But T0 is also available as an option which will disappear in some time. Having said that, the same capital is available to trade for the client in any exchange, any settlement they see a price mismatch or they see a value, they can just do that. And as regards pricing, the arbitrage opportunity is always, the algo traders, the software, they ensure that the prices are always at par. For example, again, India has two major stock exchanges, the Bombay Stock Exchange and the National Stock Exchange. We have, in clearing and settlement, we have interoperability. So if you buy in one exchange and sell in the other, there's the same clearing operation, the positions get netted and your margins get released. So India has experimented a lot with its settlement system and it's working fine.
Perfect. That's the really positive message we got. Hopefully to give confidence to the EU-UK reform. Rina, so with the new technology, everything, so what automation standards can be introduced to harmonize settlement operations across the Euro system?
Well, as FESA or as at a federation of exchanges, we probably don't have a view, but I can offer you my personal thoughts on the topic. And I said, as previously outlined, I think a shorter settlement cycle will mean for Europe we need a very, very coordinated effort among all stakeholders, and really post-trade services are highly fragmented in the EU across national lines, legal regimes, market practices. You mentioned T+2 and the changes needed there, technical standards that differ, service providers that differ. So I would invite Europe to think a bit more visionary. What is really the re-engineering potential we have? Because, you know, if I looked at, for example, many national retail markets are still very fragmented for retailers, and I'm starting at a very low level here, you know, that the national retailers are usually not able to trade other geographies very easily or only at very high cost. It underlines the inefficiency and the complexity in the old systems we have across the continent. So I think for industry, that is probably a good exercise to look at re-engineering potential. If we truly do the switch, and if it is the second half of 27, and I agree to what Dirk said, there's probably very little doubt because there's strong political agreement that we're going to move. Okay, then use the opportunity that it truly does make a difference for Europe and that it's not something done in vain. And I think that's a little bit the fear that Stefanie outlined, and I very much understand that. And I think if we Europeans just sort of stick by the law and replicate what the Americans do, we probably are missing an opportunity.
Thank you. Yeah, I hope you have found the discussion interesting so far. We have a couple minutes toward the end of the session. Maybe I open to the floor for any questions you may have.
So feel free to ask some challenging questions, right? Here we go.
Just a second, hold on a second. Thank you. I didn't quite understand why you get the liquidity challenge. Are you saying that if you sell something T+1 and you buy something T+2, you're going to have something to fund?
Yeah, actually, in this case, it is the other way around. You sell T+2, so in 2 days you get the cash.
Right.
But the same day you buy T+1, so you are short 1 day the cash.
Right.
And that's a big challenge for the investment managers, and it happens quite frequently because very often funds are invested into certain categories like car manufacturers or whatever it might be. And you might then sell the German one today and buy the US one today, but then you're going to be trapped with this liquidity gap with 1 day. The other way around is a little easier, but you have to change the other way around. You have to basically invest the cash somewhere.
Yeah. And so, so I'm from New Zealand, sorry. This is something that sort of caught us a little bit by surprise that this was happening, which is fine. But there's no plans for the SEC to require US Treasuries or the more liquid bond markets to change? Question mark. That's question mark, isn't it? Well, maybe it's a question for Thomas.
I think, Thomas, you would be best placed to answer that question. Not sure whether you were able to follow. It's around the clearing for fixed income products in the US.
And the question, I apologize, repeat that question again?
Yeah, so Sarah here from New Zealand. We understand that some credit products are going to T+1. It's not just equities in the US. But is there any signals, I suppose, from SEC, who I understand required the move to T+1 anyway, for the US Treasuries and the more liquid bonds to go from T+2 to T+1?
Yeah, as I understand it, U.S. Treasury is on T+1 today. So hopefully that eliminate that confusion. But you are right, Sarah. It's not just equities. It is municipal bonds, corporate bonds that will also transition to T+1 in the U.S.
Okay. Thank you.
Sorry, just maybe one addition on the liquidity aspect with regards to bonds specifically. In terms of market making, even if you are in an entirely T+1 environment, it means that market makers have less time to put together their inventory to be able to provide a price. And this could have also an impact on the liquidity, especially on corporate bonds.
Yes, my name is Markus Kronz. Maybe a question towards Thomas or more generally to the auditorium. So far we are working under the assumption the shorter the settlement period, the lesser risk we are all facing. So we got the proud announcement from India that they are even heading to intraday almost real-time settlement. Whereas Thomas explained to us, no, we can't do this, this increases the risk, which is quite a contradiction. I would be more interested why Thomas has the thinking that increases the risks to go more into an intraday real-time settlement mode.
That's a good question, and I apologize not to contradict our colleagues in India, but in the U.S. market, specifically for the U.S. market, we believe today we're dealing with issues, and I think the panel highlights that on ETFs or other products, the FX issues, and other products that we're concerned about in the T1 world. And so where we are today, based on the infrastructure, based on the global nature of markets, based on products like securities lending, ETFs, and the FX component, we believe that really the optimal equilibrium in terms of settlement here today, in today's world, notwithstanding discussions on blockchain and things like that, but in today's world, with today's infrastructure, we believe the optimal level is T1. If moving that slightly to T+0, some notion of that, we believe would embed more risk in the system. We're having a conversation about the complexities of moving T1. If you can, I think it would be some magnitude of order substantially higher getting to T0 world in today's marketplace. But I will say, and I would not underestimate, even in the T1 world, underestimate the ingenuity of this industry and the members and the participants in this industry. I'm optimistic that we're an innovative industry, solving solutions, mitigating risk, and I think leveraging technology, automation will ultimately be the theme of the day as we move through T1 here in the US, and understanding where folks are overstaffing now, working on shifts and looking to really meet the new requirements in the US. I think that ultimately, after we transition to T1, that folks are really going to look at their technology stack, understand what their people and their processes are, and really look to streamline these processes in a more automated fashion. And I think there's good opportunity there.
And the risks are various. There are operational risk, and there are price risk, and there are default risks. So moving from T1 to T0 will create so many operational hassles that will create a risk of its own in terms of system working properly. Probably that is what was being indicated, if I've got it correct.
And I think another element, and you need to correct me if I'm wrong, but for T+0, you would have to also apply pre-funding, right? And that is also a challenge for a lot of institutional flow. That is not what you would like to see. T+1 still gives you an opportunity to have some netting benefits, and from that perspective, I think T+0 is going to be a big step. Also technology-wise, what we are looking at today, Target 2 for securities, is not T+0. It is T+1, but not T+0. And then the other element, which has not been really referred to in detail so far, is also on the securities lending side. So the expectation is that there will be more demand. The question is, will there be probably also less supply at the same time, because the lenders might be scared that their position is not going to be back on time. That is also something we have to see in reality, right? How it's really going to play out. So I think it's a important transition now in the US market. It allows us to watch this space and learn from it, and then apply the right measures for Europe and whatever we plan to do then going forward on our side.
Hi, Peter Stein from ASIFMA, and thanks for a great discussion. I'm just curious whether there has been much discussion about the move to the effective impact of T+1 on overseas market participants who may effectively have to pre-fund not a T+0 but a T+1, and whether that has been factored in terms of the cost-benefit analysis, that for a lot of market participants overseas, US may become a pre-funded market, and if you have other markets move to T+1, that may lead to the same outcome.
Is that a question to Europe now, from your perspective?
I guess maybe it's a question for Tom, but then others on the panel, please feel free to.
Yeah, thank you. Maybe Tom, you want to give it a start, because I think.
Peter, that's and I appreciate that question, and I think it's a legitimate question. We've had discussion with your team on this issue as well, and no doubt the sands are shifting, right? So I thought that the FX, the Foreign Exchange Professional Association, put out a fantastic document where. For the buy side, where they highlighted approximately 10 different mitigants to address that. No doubt, pre-funding and financing are, at least in the near term, may be something that market participants will seek to leverage. But there's additional ways to, whether it's follow the sun model, transferring the trades, opening new locations, extending staff hours and the like, will perhaps be some mitigants to address some of these. But no doubt it's a consideration, and it's something that we discussed quite a bit.
And maybe to add one aspect, obviously next week we will see certain disparities happening. For example, multi-traded securities. We have a lot of US securities, you said it. So there we will have a discrepancy between the US, and I think not all the markets will also treat that in the same way of record and ex-date. So potentially you will see some price differentials in certain markets between the US and the European markets, the ETF markets we have discussed. So I think it'll be food for thought, and certainly a learning exercise to see how that will play out.
Yeah, I think that's a good point, and we will wait to see and learn from the US lessons. With that, I will end the session, and hope you enjoy the discussion and find it useful. But please join me to give a big hand to my panelists. And thank you very much for listening. I hand over to Mike.
Yes, now it's up to me again to speak to you on this conference, at least this year, for the last time. Thanks everybody for coming. I hope you did enjoy it in many ways. I think we had a very, very interesting and fruitful day with some very remarkable keynotes. And as mentioned before, I was very euphoric. Let's see whether this is really a happy and lucky streak. Or, I mean, we can, whatever the industry can do to help regulation to become more simple and less complex, I think we will be very happy to do. And I would like to thank everybody who came just for the conference today. Highly appreciated. I hope you did enjoy it and it was worthwhile coming to Frankfurt, or if you are from Frankfurt, to join us here. For the ICSA delegates and observers, the bus will take you back home to the conference hotel. And we all meet at 4 o'clock in the hotel lobby again, where we will hike to the Städel Museum. And in the afternoon, finally, we're going to have already, unfortunately, our farewell dinner. And I thank you very much, and I hope you had 3 interesting days in Frankfurt so far. Thanks very much.